right. Good afternoon, everyone. We're good? All right. So my name is Kyle Pomerlow. I'm a senior fellow here at the American Enterprise Institute. Thank you all for joining us both here and online for our two-day conference, The Future of International Tax Reform. So in the last 10 years, lawmakers passed two major tax reforms, both of which made big changes to the way multinational corporations are taxed. In 2018, TCJA introduced a new system, and in 2025, the OBBA, or the OB3 Act, made some significant changes on top of that. And although these reforms were big improvements, they're not perfect. And meanwhile, elsewhere, the future of global tax cooperation is highly uncertain. So to talk about the future of international tax, we brought together a group of economists, practitioners, academics to take stock of where international tax policy in the United States stands today and to answer the question, what should be the next for international tax reform in the United States? And our discussion will not just be limited to small tweaks. We'll also be thinking big about what principles should be guiding us and what large reforms we should be thinking about. Now, before we begin, I want to thank our co-sponsors, and at the risk of not naming everyone, I'm just going to leave it at that. The co-sponsors are listed on the event page. I also want to thank AEI's staff and Ali, my RA, for helping put this together. Two notes on housekeeping here. So each session is going to be 75 minutes, about 60 minutes for discussion, and then about 10 to 15 minutes for Q&A. There will be microphones in the room during the Q&A session, so if you have a question, hands up, wait for the microphone, and then express your question in the form of a question. And then one piece of housekeeping for our participants or conference participants is that prior to your panel, make sure that you head to the green room to get mic'd up in preparation for your session. And with that, I'll hand it over to Mindy, my co-host.
Thank you, Kyle. So welcome, everyone. And thank you to AEI for hosting us here to talk about international tax reform. This is the third year we're doing a tax policy event in conjunction with AEI. And so really thank you to Kyle for taking the lead and for your enthusiasm in working on this. What are we trying to do here? How did this come about? As Kyle mentioned, it's been almost 10 years since TCJA, major piece of international tax legislation, was passed. If you could go back even further, TCJA didn't spring out of nowhere. It was really the product of over a decade of work, of very thoughtful work by policymakers. TCJA was a response. I think of it as a response to a very particular set of circumstances, and that was a U.S. tax system that had remained basically fixed for several decades before that, while corporate tax systems in other countries had morphed considerably. And so what resulted was a system that was really out of balance between the U.S. and other countries and the rest of the world, really. Arguably, many of these problems were addressed by TCJA, chief among them inversion, so U.S. companies moving overseas or moving intangibles overseas. So what that has meant over the past 10 years is that much of the tax policy work since that time has involved tinkering on the edges. And so even OB3, as Kyle said, even though that was really a large piece of legislation also, it really was addressing problems or concerns related to TCJA's enactment. But of course, it would be a shame and really not possible, actually, if the U.S. tax system didn't continue to evolve and change in response to changing circumstances. And so really, we put this together to think about over the long term, how the U.S. tax system should be going strategically in light of technological changes, changes in trade policy, supply chain evolutions, and of course, geopolitical changes. A second part of what we need to be thinking about is, from a U.S. tax perspective, is how can the U.S. be proactive rather than reactive, thinking about international tax policy on the global, in the global arena? So not everyone might agree with me on this, but to a large extent, the U.S. has ceded leadership, and much of the multilateral work has been responding to other countries' initiatives from a really defensive posture. So the other question I think is that's important to think about from a U.S. tax policy perspective is how can the U.S. reassert leadership in a tax policy space? And I think this went off. No? Okay. And what kinds of initiatives or what kinds of policies might enable the U.S. to retake that leadership role? So this 2 days is about thinking about both how the U.S. tax system should respond for international tax on the domestic side, but also from the global perspective. And we start off, our first task is to think about what principles should be guiding us as we think about international tax reform. From there, we're going to move on to how should we be thinking about our CFC rules going forward, both from the perspective of how TCJA changed CFC rules and also on a global and a multilateral space, how Pillar 2 changed the dynamic among countries. And there, we're also going to talk about the foreign tax credit, which is really a central feature of the U.S. tax system, and as anyone who works in this area knows, has been something that U.S. policymakers have struggled with developing the right rules for. Also talking about minimum taxes. We've all seen a proliferation of minimum taxes and taxes that use alternative tax base. And so what is the role of minimum taxes? Looking forward to a great discussion there. And how should we think about tax incentives generally, specific and in the cross-border arena? Finally, we've had suggestions for both from within the U.S. and from other countries for either one could say reallocating the tax base to move it, shift it towards market countries, or redesigning the U.S. tax base. So again, we look to a location, a sales driven allocation method. So great discussions for all of these topics. Before we get started with them, I want to give thanks to Kyle and also Paul Osterhuis and Pat Brown, our partners in crime for the past several years, really working on these topics together. It's been a pleasure working with you. And then the larger group of really extraordinarily dedicated practitioners who've got day jobs, but who have taken on all of these topics with zest and enthusiasm to be thinking really from a high-level perspective and also objectively about improving the tax system. Thanks again to AEI for hosting, University of Florida for sponsoring. Kyle didn't want to mention it, but I of course have to thank University of Florida. And then also we've got two students here from Columbia Law School. Columbia Tax Journal is going to be publishing the papers here, and so thanks to the students for leading the initiative on that. With that, it's our time for our first pen.
All right. Thank you, Mindy. Thank you, Kyle. Welcome, everyone. Thank you for being here online as well. This first panel is going to be about general principles. And so we're going to approach this in three parts. We're first going to talk about sort of traditional general principles of taxation or international taxation. We're going to talk about which developments have perhaps forced these principles to change, how do the principles interact with a changing international environment. And then finally, we're going to briefly talk about how to apply these principles to specific provisions. Mindy is going to lead us off with a slideshow on the general principles at first. It's interesting. So in domestic tax, of course, the principles we usually think about are the efficiency, equity, transparency, and then some desire for revenue. On the international side, things are, of course, complicated by the fact that we do not weigh the interests of foreign residents and governments as much. So we care a lot less about revenue that goes to a foreign government than revenue that comes to us. We care a lot less about inefficiencies created in other countries than here. And so that's really where I think the complications arise. And you see that reflected in a set of principles in international tax that ultimately looks recognizable but quite different from the principles in domestic tax. But enough from me, Mindy. I will let you talk about these general principles.
Thank you, Stan, and thanks for keeping us honest. Are you going to introduce us, Stan? Did you introduce Lil?
I will. So I was going to introduce everyone as we start talking, but I'm happy to introduce the panel right now. On the far right, we have Lillian Faulhaber, who's the Ralph H. Dwan Chair in Taxation at Georgetown Law School. Then we have Mindy Hertzfeld, Professor of Practice, University of Florida's Levin College of Law, who we heard from, who's organizing the conference. And then here, right next to me, is Will Morris, Global Tax Policy Leader at PwC.
Well, I asked you to introduce us just so I could say that Lily and I and Will are all lawyers by training and practice. And so we're relying on you as the resident economist to think.
I'll say that word lost a few times. It's a big one for us. Yeah.
Okay, so we've embarked the global tax community. I'll say we've embarked on really more than a decade's effort of significant revisions to international tax policy, but really that effort has been undertaken without any attempt to articulate what principles should form the basis for the rules that we have or where we might want to be going. I look to you there, Will, who's been closely involved in these efforts for many years for confirmation of that lack of principles. And so as we, he neither affirms nor denies. As we were putting a lot of effort into thinking about where we want to be going, where the U.S. might want to go, putting U.S. interests at the forefront, we thought it would be useful and, more than that, very important to start with articulating what principles should guide the next phase of international tax reform. And so that's going to be our discussion for the next hour or so. And as Stan said, when we think about international tax principles, we first, of course, start with domestic tax policy goals. And so as a general principle, and Stan will correct me if I don't capture these properly, number one principle for any for any tax system is revenue collection. That's always that's why we've got tax systems. A second important one is generally equity and progressivity. So we always want. So historically, when governments enact a tax system, generally they want that system to be equitable. That obviously means different things to different people. I'm going too long, right, Stan? I
No,
got
no,
8
you're doing
minutes
well.
here.
You're doing well. I was waiting for you to describe what equity meant in this context.
Not
When
gonna
I
try.
teach, I tell my students, it's, you want to make sure the money goes to the people you like, like farmers, senior citizens, that kind of stuff. Yeah,
Okay, so Stan's got an even more cynical definition of equity than I do, but really a tax system can't sustain itself unless a large portion of the people who are being taxed view it as equitable. And also an important aspect, certainly of the U.S. income tax system since its early days, has been progressivity. So ensuring that people who, and I'm going to give a definition of progressivity that not everyone might agree with, but that people who have the wherewithal to pay more should pay more. So a third, and here we go to the economist, a tax system should be efficient. Again, a term that's subject to multiple definitions, but as a general rule means minimizing behavioral distortions. So the tax system shouldn't interfere, shouldn't cause people to behave in a way they wouldn't otherwise. Do I get that right, Stan?
Mm-hmm.
Okay, thank you. And then we go to really practical considerations. A tax system must be administrable, so you could design a really beautiful tax system, but unless tax administration can apply it, enforce it, unless people can apply with it, will last, because I guess he thinks that maybe our international tax rules are not so administrable. I don't know. So,
I got my 4 minutes, I know.
okay. Stability. So a tax, and this is obviously a big problem here in the U.S. Tax system needs to be stable in order for people to have confidence that whatever decisions they make will end up, the same rules will apply over the long term. And then final point, which is kind of tangential to the design of tax systems, but which we and other countries have been relying on more and more, is that tax rules can influence social behavior, both to guide people to certain desired behaviors or to penalize them for engaging in undesirable behaviors. Did I miss anything, Stan?
No, I think that's good. I think the most extremist economists would count that influence in social behavior categories as efficiency. I think in the international context, it's interesting actually, because I think preventing inversions, for example, is a good example, is a clear case, I think, of trying to influence social behavior. But yeah, go ahead. No, this is good.
Okay.
No complaints from me.
All right. So then, as we go on from a purely domestic context, right? So when the U.S. income tax system was developed and its early days, really the primary concerns were domestic, and still really today, of course. But we're talking here about international tax policy, and so how do we think about applying these very purely theoretical concepts to the design of international tax rules? And so here I quote from a joint committee. There's a quote from a joint committee report from 2021 on our international tax system, and as the joint committee notes, in a cross-border open economy, which of course the U.S. is, significantly less consensus on the principles that should be used to evaluate international tax policy. So that, of course, is why we're engaged in this discussion here, because there's much less agreement on how to translate these domestic tax policy goals into the international tax realm. So if we look back, going back to the early 20th century, I'll say, the principles that economists and lawyers also, I think, said would be guiding, that were important to guide international tax policy, because they were searching for other principles that weren't the same as the domestic tax policies. They landed on this idea of neutralities, and so said cross-border tax rules should be neutral in how they're influencing. So this, I think the neutralities point is really an efficiency point. They should be neutral in how they're driving investment, foreign investment and domestic investment into a country, and that's capital import neutrality. and or probably not an and, or they could be neutral in how they're incentivizing investment outside the country, capital export neutrality. But both neutralities are really about how tax rules could or should be designed so as to minimize or encourage individuals or businesses to invest either within a country or invest outside the country.
We should pick up.
Stan's going to correct me. I should talk more quickly. Okay. From neutralities, we went to, that's all right, because Will has nothing to say anyway, right?
Take my time.
Sorry. Anyway, neutralities conversation really morphed into a conversation about anti-avoidance. That's really been the BEPS project over the past 10 years. So away from neutralities to thinking, to designing tax rules with a primary focus on avoiding profit shifting, avoiding base erosion, and also making sure that the location of profits or assets or company headquarters was aligned with where economic activity takes place. Okay.
So would you summarize that as a shift from efficiency to equity?
Oh, interesting. Maybe along with your point about inversions, you told me to speed up, Stan, so I don't know if you're asking me a question, but maybe if we're thinking about, like your point about how inversions is really a conversation about efficiency, maybe anti-avoidance is about efficiency. If tax systems of different countries are encouraging businesses to locate intellectual property in one jurisdiction or another, maybe the anti-avoidance conversation is also really an economic efficiency point. Okay, so that's where the conversation has been and has morphed over the past 60, 70 years. What I did in preparing for this was I went back to 1923, when there was a report by 4 economists that was really fundamental in the way our international tax rules, our global international tax rules ended up. And what these economists focused on as a way to design, for the design of tax rules that allocated or decided how profits should be, or how taxing rights should be allocated among countries, was this idea of economic allegiance. So the notion of economic allegiance should govern where profits were taxed. And they looked to 4 criteria to determine economic allegiance. One is origin, where are the profits produced, what they called yield, substituting profits for yield. Situs, where are the results of the economic production found, so physical location or economic alignment. Enforceability, the practical point. So again, tax rules are only as good as they are enforceable. And then domicile, which is what we now call residence, where's wealth spent or consumed, who owns the wealth. So the economists came up with this principle. My takeaway from reading the report and their analysis was that economic allegiance and all these criteria are really heavily political, because you could weight any one of these criteria as you wish. It's a political decision as to whether domicile or origin or the other two, situs or enforceability, are more important. And so at the end of the day, it's a political, this economic allegiance point substitutes for a political decision, but of course it sounds better than just we're going to whichever country is more powerful gets to decide. Okay, so where does that leave us today? So if we're thinking about domestic tax policy today with a cross-border wrinkle, and we take into account the 1920s discussion and their really significant effort to develop economic principles, get to a point that there's no clear economic principle, and maybe this is why the past decades of effort didn't try to articulate one, perhaps I'm being too generous. There's no clear economic answer, but we do need to address domestic tax policy goals for a number of criteria, which I've listed here. Others could have tell me I've forgotten something. Prevention of double taxation, obviously important for everyone. encouraging U.S. innovation and economic growth. So another way to say that is being globally competitive, attracting foreign investment, equity, and if we can't define equity in a domestic context, even harder to decide what it means in a cross-border context. What is global equity and what's the role here? Administrability, still super important and even harder to apply in a cross-border context. Stability, again, really important because we need to take into account not just domestic considerations, but also geopolitical changes. And then second order goals, which I put as preventing cross-border avoidance and perhaps protecting the corporate tax base in the form of minimum taxation. So with that, I know I'm over time, sorry.
Very good, Mindy, thank you. Will, what do you think? Are these principles correct? Are they applied consistently by the policymakers?
Maybe and no. I think the answer to your two questions. Does this go backwards as well?
It does, the red button.
Okay. So I think it took me a very long time, maybe decades, of doing tax policy to learn that it is so inherently political because it is about money. So I think all that tax policy can do is to impose some type of a structure on what is a political set of decisions. Now, that's not bad, but we should be realistic about which way round this comes. So actually designing good tax policy and then expecting the politics to follow that isn't going to happen. But there's nothing wrong with that. So on economic allegiance, this is interesting. I mean, I had not read those 1923 reports or lots of other reports from the 1920s. I mean, another idea which comes out and actually still in some senses underpins the tax system, which is the idea of residence, actually comes down more to the fruit of the tree argument, which is that if you seed the investment, then you get what follows from that. So you can agree with that or disagree with it, but that is another principle which is out there. Some of you will recall, those of you who are old enough will recall, in the late 90s, I spent my 3.5 years at Treasury trying to defend capital export neutrality. I learned a couple of things about that. The first is it is really hard to defend. But the second, which my colleagues in the Office of Tax Policy taught me, is that in economics, a really lousy idea can just carry on, sort of ruling the roost until a better idea comes along. And no better idea had come along. So, Peggy Musgrave, bless her, we were still stuck with capital export neutrality going into the late 90s. It didn't work so well. Okay, so here are these, the 6 principles, all of which I agree with. But as you said, what happens in the international context? Well, here's the problem if you don't start with any principles at all. You get something that looks either like Pillar 1 or Pillar 2, depending on your preference. So I'm just going to apply this to Pillar 2 just for a second. So revenue collection, well, as you may remember, this came first with some very, not huge, but like a couple of $100 billion, euros, dollars, whatever they were, of revenue. That number continues to go down and down and down. So revenue collection, maybe. Equity, I don't think so. I mean, if you're the UK or Germany and you have a certain type of tax system, this is supremely equitable. If you're somebody else like the US, less so. Progressivity, probably not relevant in this case. Efficiency, no. Administrability, well, we are, 2 weeks away from filing the first set of Pillar 2 Globe Information returns. Not so administrable as it turns out. Stability, no, I don't think so. I mean, if they hadn't changed the UTPR from being about high tax to low tax into this like profit maximization thing, well, then maybe it would be stable. But isn't influencing social behavior? Yeah, kind of, but not in the way that they intended. So, these are great principles. It would have been helpful to have started the Pillar 2 process with those as opposed to sort of overlaying them as we approach this disaster area. But no, I don't think so.
And in fairness, I mean, even in the domestic context where things maybe are a little more straightforward in terms of these principles, there's still often trade-offs between the different principles.
No, I mean, like I said, it is inherently political. But if you can at least have a template of principles that you sort of talk about closer to the beginning and the end, then you stand some chance of, sort of reining in some of that.
So do you think? Can I? Do you think if they had started with articulating these principles, they would have ended up in a better place, or do you?
Look, I mean, you all know what I'm going to say about this, whether it's Pillar 1 or Pillar 2. I mean, if you'd started with a discussion about what the principles should be here and actually what the theory of the case was, then you might have moved forward in a different way. But what happened is, this is the usual, fire, ready, aim. You start with a problem, you try and solve a problem, and then you try and retrofit the tax policy to that. And that's kind of what keeps on happening. But if you'd started with the principles, you might have at least eliminated some of this.
I feel like I heard exactly those words coming from you in public consultations.
Indeed. And was I listened to? No.
So I want to just flag Stan's comment, I actually think, highlighted one of the challenges with coming up with tax policy goals in the international space, because it's hard to prioritize domestic interests. So we're talking about how the US is going to come up with principles for international tax reform. But it's hard to define US-only tax principles without taking into account the interests or the demands of other countries. And I think this is one of the big things that's different about international tax principles. And focusing, and this makes it tricky because the United States doesn't want to define principles entirely based on how other countries are viewing the tax system. But when you say we care much less about equity, efficiency, revenue than other countries, I actually think that's a great snapshot as to why other countries have been pushing back in the last 10, 15, 20 years, right? Is that they're saying, wait, the system that we have right now, we don't agree with the version of equity. We don't agree with the version of efficiency. We don't agree with revenue raising, who's raising revenue and how. And so the United States right now may still be powerful enough to threaten tariffs or Section 899 or Section 891. But if you think about the last 15 to 20 years, I think you can actually see a lot of examples, and I'll talk more about this in a few minutes, but it's worth thinking about right now of how other countries' actions have destabilized the United States' preferred view of the international tax system. So you can look at DSTs, Pillar 1, Pillar 2, UN negotiations, even some of the demands that led to BEPS. And taxpayers around the world and countries around the world, they still want revenue. They probably want revenue more even than they did 15 years ago. They still want an equity that favors them, whoever they is, right? Who are these taxpayers? Are they the multinationals in other companies? Are they in other countries? Are they the domestic companies in other countries? Are they the individual taxpayers? And they still want something that favors them. And the United States has had to respond to all of these developments in various ways and is going to have to continue doing so. And so I think for this discussion, one thing to consider is how can we make sure that the principles that we're coming up with are either strong enough to withstand these challenges from other countries, or in some way incorporate challenges and interests of other countries without abandoning the interests that motivate the domestic tax policy goals. So I think, Mindy, you already started to talk about this, about just how domestic tax policy goals, it gets harder as you shift over to international, but I think you can see the ways it gets harder by looking at all the ways that other countries over the last several years have been targeting both US companies and US taxpayers generally in the United States.
Mindy, do you want to respond?
Yeah, I'm just like kind of a variation on the question I asked. Well, could we have foreseen that and been, like going back to my first point, we've been defensive and reactive. How do we turn that to be more proactive, like more constructive and anticipating where things are going at the behest of other countries and get ahead of it?
So I think some countries would argue that we have not just been defensive. For many, many decades, we've been offensive, right? That we, the United States has led in many good ways, but other ways that other countries may have seen as challenging or surprising, right? We can talk about international tax norms, but the United States has led consistently with various tax rules that at first were controversial and then became adopted by other countries. So you can see GILTI as the most recent example. I mean, there are actually more recent examples, but you can see GILTI as a prominent example of this that then led to Pillar 2 and led to minimum taxes. You can see CFC rules as this, right? In the 1960s when CFC rules were passed, this was very controversial. This was seen as the United States kind of going rogue, and then you look at the dozens and dozens of countries. So I think it's not just that the United States has been defensive. I actually think there's constantly a give and take between prioritizing our interests and acknowledging that countries will react in different ways to that prioritization of our interests. And sometimes their solution is to use multilateral negotiations in a way that supports the United States. Sometimes the solution is not to do that, right? To not engage with certain things that we think are actually undermining U.S. interests. But I don't think there's one. It would be great if there's one easy response to this to sort of say this is exactly how we take account of these. But I think it is important to see that a lot of the international moves have been saying countries that maybe didn't have a seat at the table or didn't have as much of a voice are now pushing back, and we see that in U.S. policy, right? We see that we have to respond more to some of these challenges.
Well, so I think this sets us up nicely for our
Great.
second topic. So Mindy,
Can I just ask another?
Yeah.
you can go ahead.
Why did we think that if guilty was like a U.S. interest thing, how did it become on a global stage something that was in the best interest of the U.S. to something that was so U.S. viewed as so pernicious? I don't know that there's an answer to that.
Well, so I think that's an interesting story that I'm not sure that we want to go all the way into. But I will say I think it's very interesting to watch how different administrations used their versions of guilty and use their versions of guilty to either inform Pillar 2 or their versions of Pillar 2 to inform guilty, right? I think that actually if you look at the version of Pillar 2 that was being used to try to change guilty under the Biden administration, that was actually a different version of guilty in some important ways than the version that was passed in the TCJA. And I think that difference in some ways is part of the story, and part of the story is sort of which side is pushing forward. Is it the OECD or the United States? I think also guilty is interesting because there was a version of it that was proposed by Obama. There was there were this has been an idea that's been in the United States, and the fact that it was passed by the TCJA, it was not an unheard of element, unlike, say, other things that came out of the TCJA. Yeah.
Right, but I mean, just on this one, I mean, there are at least two theories of the case with your minimum taxes. And guilty was essentially that you put all corporate groups on the same level, so that you have, the dreaded worldwide calculation and all that, but that each group essentially pays 15% on its rest of world income. But really what the Europeans brought into this, and probably the French in particular, was a different theory of the case, which essentially was about tax harmonization, which is you have to pay 15% in every single country. And again, if there had been a policy discussion about that at the time, then maybe you could have figured out what was going on. But that was kind of slipped in when the model rules came out, sort of perfectly formed in December of 2021. And there was never that discussion. So then as you try to figure this out, I mean, obviously the Biden administration brought different things to this in terms of wanting to raise the tax on US corporations doing business overseas anyway, well beyond 15%. But they were different theories of the case. And to a certain extent, they're irreconcilable. And that's what we've seen. And that's, to a certain extent, why we are where we are. But again, if you'd had that discussion earlier on and tried to figure out what it was that you were trying to do, that was good. I mean, for the French, this was much more about protecting their tax base.
We've talked about the 1920s, we've talked about the 1990s, we've started talking a little bit about the recent past. Lillian, could you tell us to what extent these principles, how they interact with changes in the technological environment, in the geopolitical environment? Do they remain the same? Should we discard some?
Yeah. Yeah, so I wanted to talk a little bit about sort of why we're talking about changing principles, right? These are all good, strong principles. We all talk about them. What's happened that has led us to be having this conversation? So, I think you can see even before 2013, which is when BEPS 1.0 started, there had been calls for changes in the tax system. So you had high tax jurisdictions. For years, they'd been arguing that the system needed to police tax competition differently. There had been years of countries pushing back against each other and even within their own legislative systems to determine what counted as tax avoidance and where countries were allowing insufficient payment of taxes. And BEPS itself showed that some high tax countries thought that the system was not focused enough on double non-taxation and tax avoidance. But I think that you can see there are a few key issues that countries really started to focus on as weaknesses of the existing international system starting around 2010. And they all suggest that the international tax system was not keeping up with a changing business environment and changing geopolitics. So in a previous article, I argued that there were three major issues that led a lot of recent proposals for change. And those were, first, that the physical presence requirement was outdated, right? That the economic allegiance that relied on physical presence shouldn't apply in a situation where you could do business in a country without having a presence there. The second issue that I think there was a lot of pushback against was the availability of low tax rates in certain countries, which meant that those countries could become a location of significant profits without having to have much of a tie to the business, right? So this is tied to the physical presence, but there really was a changing narrative around the low tax rates, whereas previously there had been sort of an acceptance by a lot of countries of the idea of sort of free tax competition over rates. And the third change is that there had been a rise just generally in the degree to which multinational corporations with significant profits were not subject to sufficient taxation. So this was a focus on multinationals, particularly large corporations. Now, on top of this, I think it's also important to note that countries that had previously not been at the table when the international tax system was shaped felt that they were not getting a voice and that they needed more of a voice. And tied to all of this, you can see there was this overall sense of fairness. I put that in quotes in case you can't tell, right? There's a sense of fairness both between countries and within countries. And you can see this in a lot of the rhetoric about level playing field. And you can see this also in all the discussions about the big five tech companies, or GAFA or FANG or whatever they want it to be called, the target on them specifically paying more. And so I think all of these criticisms are underlying a lot of the recent pushes for tax reform, starting with BEPS. So there were the efforts to target the digital economy, first to define the digital economy, then to target whatever companies were seen as being part of the digital economy. There were the changes to the physical presence requirements. So even before the end of BEPS, you had substantial economic presence rules, you had withholding taxes, you had DSTs that were already coming into effect. There were also changes that were starting to target low tax jurisdictions. You can see this in the US with GILTI in certain ways, right? This was our minimum tax, and then Pillar 2 and other minimum taxes. You can see this with rules that were focused on large multinationals. So there was the diverted profits tax in the UK, there was the multinational anti-avoidance law in Australia, there were all the digital services taxes, there was Pillar 1, there's CAMPTI in the United States that's focused on very large corporations. And I think there are two things to note within these developments. So first, these criticisms matter for the US when they're raised by other countries because they subject US multinationals to multiple layers of taxation. You'll see this with criticisms, particularly of things like DSTs, right? Where each one layers on a new level of taxation over an already complicated tax system. And they raise questions about creditability, and they change the competitiveness of the United States relative to other countries, thereby having an impact on our own tax system and on our ability to pass our own desired reforms. But second, I think what's interesting is that these criticisms are also shared by at least some parties within the United States, right? This isn't something that is just coming at the United States. It's also happening in part within the United States. So the fact that GILTI had been a concept that had been out there for many years with different names, but it was actually it was passed in the TCJA in the United States as the first example of a minimum tax before Pillar 2 was proposed. You see in the United States many politicians that are criticizing US MNCs for not paying sufficient taxes. So you can see this with CAMPTI. You can see this in some narratives about GILTI. States within the United States we've seen have attempted to pass their own DSTs. There is this narrative that you have these big corporations that are not located in the US and they're not located in the state and are not paying taxes. And so many of these criticisms, even though they're strongest outside the United States and turned toward the US, there are examples of these being turned inward as well. And at the same time, countries that had previously not had as much of a voice were getting increasingly involved. So they were the ones who were raising these criticisms, and they were the ones who were part of discussions where they previously hadn't been. So BEPS itself had led to criticisms about countries that hadn't previously had a voice, right? There was a sense that BEPS itself wasn't inclusive enough. This led to the inclusive framework. That said, China, Brazil, and other G20 countries were involved in BEPS in a way they hadn't been involved in previous OECD projects. So there was a growing space for G20 countries and then more countries beyond that. And this led to the inclusive framework being created, but also to the current shift to the United Nations. And so there was a sense that these countries, they hadn't had a say in these principles when they were first established, and now they wanted to have a say as these principles, they argued, had been shown to not fit with the current situation. And so now we have a world where there are a whole host of new criticisms that have arisen over the last 15 to 20 years, and there are countries with more of a voice as well. And one thing I want to flag here is that the countries that now are having more of a voice, it's not just because they are saying they weren't part of the discussions before, it's also because they can demand more of a voice. These are countries where there are a lot of consumers. These are countries where there are a lot of users. And also, these are countries, including China, that are actually home to some of these large multinationals themselves. And I think that's another thing to keep in mind as we're looking at international tax policies, is right now the United States is home to many of the multinationals that are being targeted. But when we're thinking about principles, we want to make sure that those principles protect the United States in the long term. And that may include making sure that they're protecting source countries as we shift away from being a residence country and more toward being a source country as well. And so we want to make sure our principles are flexible enough for the long term and not just the short term. And one other thing I want to note, and then I'll turn it over for more discussion, is that not only do you have all of these criticisms of the principles, and not only do you have all these new countries that are at the table, but I think we talk a lot about the multilateral negotiations, but there are also a lot of unilateral moves that are happening at the same time. And so at the same time that there's the Pillar 1, Pillar 2 negotiations and threats to move to the United Nations, you can see that from the US perspective, countries are passing all these other rules that are unilaterally focused on multinationals. And these include DSTs, the UK DPT I mentioned, the Australia rule I mentioned, UTPRs, which I think in response to Mindy's question, that's one reason that Pillar 2 is treated differently, is because it has the UTPR. But other countries see the United States doing this as well. So we can remember the responses to FATCA, right? When the US passed FATCA and other countries viewed that as adding to administrability issues. And we can remember BEAT from the TCJA, which European finance ministers criticized as being extraterritorial and inconsistent with proposals. Guilty was seen, at least at first, by some countries as being sort of a surprising move by the United States. And then tariffs, which we haven't talked about, those are a whole other version of this, right? And so unilateral measures are not new. This has been happening throughout the history of international tax. But it is worth noting that this continues and that this is part of the trend you can see with many of these developments. So I think a lot of changes have been happening. These have all been illustrating that many countries, including parties within the United States, think that the international tax principles we're relying on now are outdated, that the system is broken, that we need new principles. And I do think it's worth thinking about these challenges, because I think if we don't make some sort of reform, we're going to keep having these challenges coming.
So simplifying maybe a little too much, to me it sounds like the developments you're describing over the past 15 years or so, there are two basic shifts. One is a shift toward efforts to restrain tax competition, and the other one is a bit of a shift from origin-based to destination-based taxation. Would you agree with that characterization? Do you think American policymakers think about it that way? And do you expect those trends to continue? How difficult is it to coordinate internationally around those principles? Because certainly for restraining tax competition, you need, ideally you have some level of coordination. But
yeah, I mean, I think revenue is always going to be the primary thing that countries are looking at, right? And if you look at a lot of these changes, there is this sense that there's revenue there that's up for grabs, right? Now, some of that, if you look at BEPS, there was a sense that it wasn't being taxed by anyone, right? That this was the double non-taxation. And then there ended up being more of a sense that, well, maybe it's being taxed by other countries, but it's not being taxed to us because we feel like we deserve it. We feel like we're creating, I don't love the phrase value creation, but we're creating, we're contributing in some way to this. And so I always foresee countries wanting revenue and having a sense that if there is revenue up for grabs, or if there is revenue that they think that there's an argument that they deserve, that they're going to be asking for that. I don't know if that's cynical or just an accurate description of taxes. But so in terms of, do I think this is going to be continuing? Yes, I think what we want is to come up with a system as we're looking forward toward international tax reform, where instead of having sort of a whack-a-mole situation, right? There's just a new rule, we're in the middle of BEPS and all of a sudden the UK proposes the DBT and all of a sudden Australia proposes the MAL and all of a sudden countries start proposing the DSTs and then all of a sudden we have a tariff investigation and then they come back, then there's UTPR and it's going back and forth. I think ideally, this is why we want to have this conversation about principles. You want to have a situation where there's enough stability and agreement on how this all works, that you're not constantly coming up with new rules and sort of trying, because there's always going to be a demand for revenue. And so you have to figure out how to respond to that demand, because otherwise countries are sensibly going to come up with their own ways to target the revenue.
So one example of that, of coming up with your own ways, of course, are the tariffs, which you mentioned. To me, it's interesting. I was looking at the program for the conference. The tariffs are not. They've been in the news a lot. They generate quite a bit of revenue now for the U.S. Did not have a super prominent role in this conference. Maybe just because the trade lawyers are a little separate from the tax lawyers. But to me, as an economist, the tariffs aren't that different from DSTs and obviously some other things on the corporate side. Do you think it makes sense to have more of an integrated discussion there? How do you think about that? Just as a
definitely. I feel like every tax conference I'm at, we always start talking about tariffs, but of course it's all the tax people just talking to each other, right? So I actually think I find it interesting because I feel as if the US government started to combine those two as soon as DSTs came out, right? They started the 301 investigations. And so you did have the USTR in the background of the Pillar 1 discussions, right? Just not physically, but the fact that there were these threatened trade responses, that if DSTs weren't eliminated, that these would come up. I actually think that was important because, as you said, normally the trade lawyers and the tax lawyers are separate. And that I actually think means that when we have something that politically is seen as a tool in our arsenal, but we're not discussing it, then when you have a Section 899 move, you have a trade threat, it's seen as being sort of shocking and like the nuclear move. But you could imagine there being more of a conversation of the two of them being together, because right now it seems as if the two of them are being sort of used more in tandem than they were before. I'm not sure how tariffs fit with the sort of general principles discussion, right? Because I mean, the efficiency issues are kind of front and center when you start just putting tariffs on things. But again, if you're looking for revenue, as you pointed out, and countries are going to come with all tools, and I think also having a lot of tariffs means that countries outside of the United States feel more comfortable targeting US multinationals with maybe otherwise unseen measures, because they say, well, you're doing something that we had thought was inconsistent, and so we're going to come back at you and come up with our own rule that's inconsistent.
I mean, tariffs, like the corporate tax, have the major advantage that you can play these incidence games and pretend that voters aren't paying them, right? That's big. It's a big plus.
I think just my shot at answering your question is, one, tax lawyers don't talk about them so much because tax lawyers know income tax rules. They don't know historically that part of it is a silo thing, and part of it is they talk about what they know. But also, I think, I mean, this is to you as an economist, tariffs just flunk the efficiency one. So they score so badly on that metric that why would you, if you're talking about principles, like, why would you want to incorporate that into the discussion?
Yeah. Will, sure.
Because they're easily administrable, obviously. Let me just go back a little bit. Sorry, just one point about tax competition, which we all know is a terrible thing and therefore shouldn't be allowed. I mean, one of the reasons why a number of the developing countries have headed off towards the UN, other than the fact that they were treated badly in Paris, is because there are all sorts of competition, okay? And countries, nation states are going to compete with one another. And one of the ways they compete is over taxes. So if you suppress that, there are a couple of things that may happen. The first is you won't be able to do it successfully, but much more importantly, you're going to get some people who feel left out, because one of the things, there was, I'm not going to tell you which, but there was a G7 country which was talking to a developing country about this. And essentially what they said was, look, we've used all of these things, including tax, to build our own economies up so that, we have great roads, we have great schools, we have all of these advantages. Why would we let you build yourself up by using tax? No, we want to maintain our competitive advantage. So always apply, sort of that lens when you're hearing people talk about competitive advantage. This is not an absolute bad, okay? I mean, it can be bad if you're talking about, completely phony tax credits, for example. That's probably not a good thing. But if you're actually trying to encourage a country, and remember, we spent a lot of BEPS 1.0 talking about DEMPI and people function, all those real things. If people actually transferred, what the real activity, then that was fine. Well, that turns out not to be fine. Anyway, okay, let me get off this. But what I want to say about what Lily said was I agree with every single word of it. I think that's all right. I just want to add something on top of that because, again, it's taken me a long time to realize this, but tax does not exist in a silo. There's actually a big wide world out there which kind of impacts it, which is why the politics is important. But more than that, so if I had to pick one event in the past 25 years which has really molded tax policy, it's actually the global financial crisis. And why is that? Well, because it sort of, in some cases, focused us on things which were already happening, and in another case, caused new things to happen, which are now impacting us, quite considerably. So one of the things that it just sort of pushed ahead was the fact that, over the past 60 years, from the rules that we know and love from the OECD, which in essence date from the 1960s with some additions in the 1980s, the GDP of the OECD countries has gone down like that, and the GDP of other countries has gone up like that. And sure, with BEPS 1.0, the G20 were involved, kind of, sort of. But actually, it's remained the case that the rules still bear the imprint from quite a long time ago, from a very different set of economic circumstances, and it's hardly surprising that some of the new players want to change that. What were some of the new things that the global financial crisis at least kicked off, although things like COVID, the pandemic, accentuated them? First, a staggering amount of money got spent. I mean, a huge amount of money got spent. And, debt to GDP ratios went up quite dramatically. That obviously has an impact on how countries feel and think about revenue. And, one thing we haven't mentioned, I guess you can never get away with not mentioning this, at some point, who is it preferable to tax? The folks who actually cast votes in your own election or somebody else? Well, somebody else. One of the principles we haven't talked about, we actually might put growth out there as a principle sometimes in terms of taxation. And that clearly has not been the story for the past 15 years. There are other things which the global financial crisis did very severely, broke trust. It broke trust in government, it broke trust in businesses, it broke trust in, you name it. And one of the things that did was in part give rise to, in this country, things like the Tea Party, but also Occupy Wall Street, so you can be even-handed about this. But that has very much influenced the politics that we've seen since then, including in tax policy. You can think about, another of the things that we've seen was, arguably, it's led to some of the geopolitical changes we've seen, both in terms of, sort of countries, in part, at least some disintegration in multilateralism, which again has also led to some of the regionalization we've seen. So, you have, best friends, China and Russia, you have the US in a different place, you have other countries thinking about that. One of the things about regionalization has had some effect on trade policy. I mean, obviously individuals and, particularly some countries like the US have had an impact on that. But, again, regionalization has had a big impact on tax policy, leading to more tax barriers, leading to more of that unilateralism that that we've been talking about. The global fiscal strain obviously has had an impact. I mean, that was part of what was behind BEPS to some extent, which again, was an outgrowth of the global financial crisis. And the narrative prior to that, which was, you can come up with any decades that you want to, but I mean, if you look at the 1990s as being a sort of unipolar decade, with the US still in a very strong position, that begins to end going into the 2000s. But nevertheless, I could bring you up newspaper headlines from 20 years ago which said, how are governments being so stupid, imposing all these tax rules, on corporations, which are the fount of growth. That was a narrative which changed very dramatically during the global financial crisis into corporations aren't paying their fair share, the broadest shoulders need to do all of this. So again, a lot of the pressures that we've seen to change tax policy have come from these events which are outside of tax, but which have a really significant impact on it. So I think to get the full picture, you need to take what Lily said and then some of what I'm saying. to understand why the pressures for this change and why this narrative about corporations being bad and fair share and all the rest of that has proved to be so enduring.
So do you think that those changes in perceptions because of the financial crisis, do you think they feed into the movements that are more toward destination basis as opposed to origin basis? Is there a trust issue there too? Does
Well,
it
no,
seem
I mean,
like where IP sits is a little
they
shady?
clearly have a part of it. I mean, that's part of the, sort of the downslope of GDP as far as the OECD members are concerned, is that countries which have larger markets, I mean, obviously the US has a larger market, which is why it's in a slightly strange position here. And, as I think Mindy or Lily was talking about, protecting both source and residence, which is something, by the way, that we see much more of in Pillar 1 with other countries. All of a sudden thinking, having previously thought they were residence countries, realize as far as digital is concerned, well, actually they're source countries. So yeah, I think it does do that, but also, some very large countries like India and China with very large markets have, put a new emphasis on this. And given that, at least as far as other developing countries were concerned, the current rules for allocation didn't seem to be working, well, they'd try something else.
Very good. I think the time has come for us to move from principle to applied principle. Mindy,
yeah,
you want to
I'm
get
just
us going on that?
listening to Lily and to Will also. I'm trying to, all these things that have happened that put pressure on the system, do they suggest that we should revise our principles, or that the principles are the same, but where they lead us to is different?
Well, I mean, you're about to talk about this, but I mean, I think we need to be realistic about where we are when we talk about what the principles are, because we can't talk about the principles in totally abstractly. Here are the right principles. I think we need to be aware of where politics, geopolitics, labor issues, trade, all the rest of those things. What is the art of the possible with these principles? I don't think the principles are wrong. As I said, I'd probably add growth. I don't think the principles are
There's
wrong.
growth there,
Yeah.
economic growth.
Well,
That's in the efficiency bucket.
Okay. So I think that you don't abandon the principles, but you need to be realistic about what can be achieved as well. And if you're thinking in a different mindset or a different worldview, to use an even grander term, then you can talk about the principles as much as you want, but if they don't fit with reality,
And the weights attached to different principles
no,
can shift
absolutely.
over
No.
time.
And but equally, I mean, this is all about fact selection in the end. I mean, where do you come from?
No.
Do you want to go?
Well, I was just curious what your answer was.
I mean, I think these principles already include a lot of the question. These are not. You have not put in principles that are set in stone, and I think this comes to Stan's point about the weight, but also when we get to equity, global as well as domestic is a question. I think that actually a lot of weight falls on how that question is answered and what that means, right? What does it mean even in domestic equity, right? We have lots of different ways of defining that, but what do U.S. international tax principles, should we be defining it to say, well, we need to have at least a sort of minimum level of revenue that every country is able to raise? Because if we don't, that's going to lead to so much instability internationally that our interests are such that countries have sort of an ability to protect themselves, or is that not what we're doing? For administrability and enforceability means different things in cross-border context. I think that parenthetical is doing a lot of work as well, right? So I think a lot of these, you've already put in the fact that there are questions, and so I think that's sort of what I'm trying to highlight, is that these have to be informed by the fact that countries themselves are going to be making demands that are going to change. Like, if we didn't have to think about other countries, we might just be thinking about domestic equity. But we do have to think about other countries. And so that actually makes us think about, well, how much do we incorporate that into the equity, or do we have something else, which is sort of trying to protect international geopolitical stability with like a minimum level, so that there's enough sort of, there aren't the same revenue demands that mean that countries are constantly challenging.
This is a big
our
issue with
rules.
having equity as one of our principles, right?
Yeah.
It's a good backdoor to smuggle in all the politics we want. That's the,
Well, I'm also thinking about how Celie Dagan from Oxford says you can't have any of this conversation without talking about tax justice. So which is kind of global equity. All right, so I didn't know how to evaluate any particular proposal. I started looking back historically to TCJA provisions, but then I was pushed to think more high level on really big policy choices. And so I took very broadly all the different principles that I come up with and thought about evaluating really fundamental choices the U.S. made early on in the income tax system. Foreign tax credit versus territorial system or participation exemption versus deduction for foreign taxes paid. And then, because I didn't know how to answer these questions myself, I fed them through ChatGPT that told me all the answers. Because Stan asked me why some greens were boxes and some were circles. So I put in, this is GPT's color or scale. So a green circle is very strong, and whereas a green box is strong but not very strong, and then the other ones are more obvious. So again, this is not my evaluation. This is ChatGPT's evaluation. So without criticizing that AI tool, I'll just take that for what it's worth. I didn't go back and forth with it very much to try and change its mind. But I thought perhaps, I welcome any thoughts here. Perhaps this is a useful exercise in trying to weight different policy choices, because how do you, I think to some of what Will just said, and Stan also, perhaps it's all a balancing exercise or a weighting, what do you care about more, and how do you want to weight things, and what matters to you most here. Again, these are not my views as to where these go, but I think I got it pretty right. I think deduction.
You can tell it works reasonably well, because whenever the revenue collection is strong, everything else is weak.
Yeah, I mean, like the equity one, I think its answers are kind of odd a little, but again, that probably goes to, I didn't tell it what equity was, and so it probably got the revenue collection. I think it did a better job on. And then to your point, Stan, I asked it to do the exercise to run it again, and I asked it to weight revenue collection double any other principle, and also I wanted to weight encouraging innovation more. That's a big focus today, clearly, and so it came up with slightly different metrics. We can have a discussion about this one, or I asked it to do a couple of other exercises. How do we think about tariffs versus the favorite of some in this room, destination-based cash flow tax versus the existing income tax, and look how well the destination-based cash flow tax scores on almost everything other than equity, and look how poorly tariff. To your question about tariffs before, look how poorly tariff.
Did you let Alan edit the answers after ChatGPT?
Like I said, I did no editing on ChatGPT's answers, and really, ChatGPT is just collecting all the papers that are out there. Right? How does it reach these answers? It takes all the literature out there, and
so one thing, this is setting the specifics aside. One thing this is certainly in the spirit of is Will's earlier comment about how imposing some structure, thinking about principles, on some level before going through the process can be productive. So, do you like this a lot?
Do I like the DBCFT? That wasn't the question, so I'm not going to answer it. Look, I think these things are helpful. I mean, obviously, part of my concern about what's happened in the past 15 years is we haven't had a conversation which has been even vaguely like this, which is, before we set off, on changing everything, what is it that we're trying to do? I mean, finding out what the problem is quite important. That's a slightly different issue, but it's a good question to ask. But then once you've actually correctly identified the problem, then identifying what the principles are, and essentially making people who want to do something argue against what it seems that the principles are. It may not restrain it. I mean, again, it does come down to politics in the end, but it will impose some type of a structure on it. And it does mean, particularly in a process which, like in the international context, quite often these things don't start with a single international government. They tend to start sometimes with international organizations. You should be very careful about those things. But nevertheless, if you do start it in that context, then having something which starts with principles, with what do various countries think about this, and what are the puts and takes going to be, then it might go slightly better. I mean, it's not always going to work, because in the end, self-interest. I mean, if you want two quick examples, the first is what we'll call low value added services, which is things like stewardship costs under BEPS 1.0, and then more recently, amount B, which didn't come to very much, in Pillar 1, which is essentially about basic costs and allocating those, or allowing those to be allocated to the country in which they were spent. Surprise, rich countries wanted that percentage to be very low, poor countries wanted that percentage to be very high, and there was absolutely no agreement about it. So, you can talk about the principles, it's not going to make you come to an answer, but nevertheless, it may squeeze out some bad things, and then being slightly more optimistic just for a second, it may actually point you towards some answers which do work better.
I got a good score from you. I mean, a good grade.
There we go.
I think what's valuable about this is that it highlights very clearly that there are always going to be trade-offs, right? And I think actually this comes to Will's point as well about how important it is to state principles early. It's also important, and no one ever wants to do this, to figure out where the trade-offs are, right? Because I think I've been focusing internationally, and now I'm going to focus domestically. We're not very good at admitting that there are trade-offs, right? That none of these are green all the way down, nor are any of them, and this may just be, like, we can maybe come up with something that's the worst thing in the world that's red all the way down, right? But there's nothing here
We can take the terrorists.
the terrorists are red all the way down, except for that glorious green circle at the top.
No, but we can fix that
and
if we make them illegal and we refund the revenue.
Yeah. Right, exactly, once you take away the refunds. But I think
also they score high on administrability.
it's true, yeah. But I think that actually is one of the things when we're talking about principles that we need to be talking about, right? Is we can talk about all these principles, but one of the hard thing with principles is you can look from the 1920s on, maybe those were the principles that guided our international tax system, but there were always different trade-offs being made for every set of rules. And so saying that these are the principles doesn't actually acknowledge, well, sometimes we went really far forward on this one and kind of ignored this other one. It was still there, but then other times we alternated. And so, this isn't ideal. This isn't going to happen because this isn't the way that debates happen. But ideally, you would set out principles and then have a robust conversation, a nationwide conversation about which ones we were prioritizing, and we wouldn't be sort of trying to squeeze things in. And but I also think in terms of sort of my point about the international pressure, you might want another principle on here, right? That is saying how is this going, how likely is this to trigger a response by other countries? Or how likely is this to lead to some sort of instability, right? To lead to some sort of UN process that ends up then maybe targeting US companies or leading to a tariff war outside of the tax base. And that could also be something, maybe that's something that we're happy to rank low if we're talking about trade-offs, but maybe it's actually something that ends up being an umbrella over everything else because it's costly enough that it's something that needs to be taken into account. So I find, Mindy and I have talked about this, I have questions about the value of ChatGPT doing this here, right? And sort of us not having a trade-off discussion within it, right? Because I think the trade-off discussion is actually sort of the most valuable part of this. So.
Don't you think your point about how countries might react is wrapped up in this stability?
Maybe, it could be. Is it? So this is my other question. Mindy and I have had, I think I asked two main questions about GPT, right? Is how do these play off of each other, and how are we actually defining each of these? Because I think if you were to sit down and say, what does encouraging innovation mean? I think you could get a lot of different answers to what that meant, right? So you could, I mean, we know equity, we know efficiency, there could be different agreements. And I think stability, you know, there's domestic stability, there's international stability, there's long-term stability, short-term stability, sort of what we're trying to capture there.
I think it would be real. I mean, these are all difficult questions for ChatGPT to answer, but the stability one would be, because that's really forward.
Yeah.
looking.
Yeah.
Yeah, but of course, everyone, you know, there's pretty broad disagreement too over which of these policies would encourage inbound investment the most. And,
Yeah. Right, because there's also the ones, you know, if it is encouraging investment, but also where is it encouraging investment, right? Are we focusing entirely on United States investment? Is that actually what our MNCs want, is encouraging investment only in the United States? You know, all of that.
Good.
Can I just
Yeah.
show my, the next one I did, which is, because we have a session on incentives tomorrow, I think. So I threw in the R&D credit versus a deduction for R&D expense versus government grants, and I did FDII because I figured ChatGPT wouldn't know anything about FDDEI because there have been no papers written about it. This is much less uniform, I think, than the other two, but the deduction for R&D scores pretty high on a lot of their.
Good. Well, with that, let us open it up to our beloved audience. Any questions, please raise your hand and then wait for the mic. Let's go all the way there in the back behind. Oh, and then I saw a hand over here.
Hi, I'm Richard DeSalvo from Joint Economic Committee. So several of you referred to the current international tax system as broken. Could you provide maybe some like facts or patterns or trends that you have on your mind to justify calling the system broken?
I don't think I used the term broken.
Sure. So I will. So my point was what I think I said is that I think a lot of countries that have proposed various measures over the last 15 or 20 years, that the measures that they've proposed have suggested that they think that there are certain parts that are broken, right? And the three that I focused on were, there's been a lot of criticism of the physical presence rule, right? We can all disagree with that, but I think what I think is important, right, is that there are a lot of countries and taxpayers and politicians who are identifying consistently parts of the international tax system that we have sort of accepted. Now, one part that I didn't mention that I think you will see a lot is just the treating separate entities as separate, right? I think that's something that actually underlies the overall criticism. And so so there's the physical presence requirement that I think has a lot of criticism. I think there's the freedom to set tax rates as countries will, right? That I think some countries have seen as broken and some taxpayers have. There's just the overall view that multinationals are able to have significant profits that they see as not as not taxed enough. I was focusing on corporate here. I think you can definitely see that rhetoric in the individual billionaire and oligarch taxation space, right? You'll see similar. Yes, so you'll see similar rhetoric there. And then what I didn't mention, but I did just mention now, is the separate entities. So I think that there's this consistency across a lot of these rules that have been proposed and passed that are suggesting that this is sort of out of step with business practices now. As I said, I think that a lot of this arises from a need for revenue and a way to shape the international tax system that will align with these countries' desire for revenue. And since a lot of times these countries either weren't at the table or they feel that their interests weren't heard, or, you know, to refer back to France, which you were referring to, Will, or they feel that maybe they were at the table and their voices were heard, but their role has changed and their sort of economic status space has changed, they feel like we need a new tax system. So I think that I don't know if others want to say this, but I think that's how I would say that sort of a lot of trends have been showing that countries have sort of similar criticisms they've been leveling against the international tax system.
So I'm going to take it up a level, as you would expect, because Lily's much better at tax than I am. So the first is that if you look at what, again, BEPS promised, which was more stability and more certainty, we've gotten exactly the opposite of that. So, I think that means that you do have to interrogate what's gone on to some extent. I point to something else, which is that the direction that multilateralism has taken, which was certainly BEPS 1.0 to some extent, but much more BEPS 2.0, essentially has tried to provide an overarching solution to all problems with one single set of rules for all countries. And that, I think, has been proved not to work because, not entirely surprisingly, countries are in different places, economies are in different places, and yeah, they have different views about this. So, again, you can go back to a slightly older way of looking at this, and just to be clear, my preferred way of looking at this, which is, when you look at international tax rules, actually, between doing nothing, which is probably not a great idea, and trying to do everything, which has now been proved not to be a great idea either, there is something in the middle, which probably looks like tax treaties or something like that, where you essentially come up with a minimum set of rules which allow different economies, different countries, different points of view to coexist just enough to, take out some of the really bad friction which will prevent international trade, assuming that you think international trade is a good thing, and not everybody does that as well. But again, we're in a slightly different place. So I think we need to look at that big issue as well. And and the other thing is, I said that everybody views tax competition as bad. I mean, clearly that's not true, because one type of tax competition which is going on is for revenue itself. It's not, part of tax competition is to encourage investment, but part of tax competition is just to grab somebody else's money as well, because it goes back in part to the GFC and to the COVID spending and to greater revenue needs. But again, being honest about that, there is not just one type of tax competition.
Let's go up there, behind the lectern. Sorry if I don't make eye contact. Sure. I can only see your arm.
Thank you. Regarding DBCFT, if we suddenly shift trillions in tax liability away from manufacturing and origin hubs and towards consumer-heavy deficit nations like the US, what are the systemic risks to global capital flows? Could a sudden shock to corporate valuations, localized balance sheets, the resulting volatility in foreign exchange markets inadvertently trigger a liquidity crisis like we saw during the great financial crisis?
So I will talk briefly because I recall being part of lots of discussions about the DBCFT in 2016. I mean, my recollection is that a lot of the criticisms really were about the transition shocks, right? And exactly as you mentioned, right? Just the huge losers that there could be at the same time that there were huge winners. And my sense is that that hasn't been addressed, although others here can speak to whether or not that's true. And I think that was one of the big challenges. There were also obviously the trade issues at the time, and I think that raises an interesting question to go back to Stan and my discussion about trade and tax, is that the discussion of DBCFT amongst the tax experts I know had a very different tenor from the discussion of DBCFT amongst the trade experts, just because of the way that it was going to be viewed in the trade space. But if others want to chime in.
Yeah, I think there were two sort of incompatible sets of concerns around the transition. One, where in effect the destination-based taxes would operate as tariffs, and so from that area from that understanding you had a lot of opposition from large importers of consumer goods, those kinds of places, and so if you believe that story, they would take a hit. A different set of criticisms understood or assumed that a shift to destination-based cash flow tax would lead to pretty meaningful exchange rate adjustments that would, in effect, offset the destination-based cash flow tax as a tariff. But of course, those exchange rate fluctuations would have a large impact, for example, on asset prices. And some of those shifts could be quite large. I think the effects could be very important for certain people, certain places. I am not sure that some of the scenarios that you hinted at would be my immediate concern. But some of the shocks would definitely be large and perhaps hard to process for certain households, certain firms, certain aspects of the financial system. I don't know, Alan Cole, if you want to add
Can I
anything.
I'm trying to take your question and put it into the discussion that we've been having. And so I think what you're saying is, but there are all these other concerns. The destination-based cash flow tax raised a lot of concerns. And so shouldn't those concerns cause us that maybe ChatGPT didn't capture here, or maybe the principles didn't capture, and what is this list of principles missing, or what are our metrics missing that they don't adequately reflect or express the very many concerns?
Well, I think stability here does not probably account for how disruptive the transition would be sufficiently. I think here the stability idea is that once you have the new system in place, how stable would it be? I think with really a wholesale overhaul of the system, it's the disruptions at the start that concern people. Of course, obviously that's not how these kinds of reforms usually work, right? You would have transition periods, and we wouldn't suddenly wake up in a world where every country had completely transformed its corporate and individual tax systems from one day to another. And so I think that also speaks against being overly concerned about some of those changes. But yeah, I think we have time for one more question. Otherwise,
well, maybe Alan wanted to say something about destination.
he's been, yeah.
Sorry, I interrupted you.
Alan is a big fan of the destination-based cash flow tax. For those of you who do not know, that's why it's pointing.
Yeah. I was in the kind of position of being able to talk about it a lot and argue about it a lot back in 2017 or 2016. I think the tariff versus asset price and kind of currency exchange impact, there's a little bit of a continuum, and it depends on how effectively it's administered and how pure one gets with the proposal. The more that you have full export rebates on everything, and the more you have everything included in
which we presumably
border
wouldn't
adjusted
have.
base, and the more you handle like quasi exports like tourism and people crossing borders and all of the things that are really tricky to handle, the closer you get to the asset price scenario. But the more you make exceptions for those things that are difficult, the closer you get to kind of the quasi-tariff scenario, where the people on whom the nominal incidence falls are kind of right to be angry. And in the political environment, the latter dominated. It's not clear how much it should have kind of dominated on the merits, but it did.
And I actually think this is a great example to end on, because I think it highlights that what we're talking about here when we're talking about just tariffs, DBCFT, these things, and you're looking at principles, what really happens when we have actual laws and we have exceptions and we have carve-outs and we draft them in order to make sure that we get enough votes for them, is that the principles are necessary for us to be designing things to follow, but also we end up drifting away from them even at the start, and then as laws go into effect longer and regulations come into effect, we keep drifting away sort of from these principles. And so ideally, right, we have this great conversation where we have a trade-off and we discuss trade-offs and we keep coming back to the principles and reminding ourselves and trying to bring them back. But that might be a little far away from where we end up being.
If I understood Alan correctly, he's saying you need to have a system with loopholes everywhere, so that the transition isn't too abrupt. All right. Well, thanks everyone. Thank you for attending, and I look forward to the rest of the conference.
And we've got 15-minute break, and then we resume with something.
Great, thank you.
Welcome to the second panel. We started off with a broad overview of the international tax system and where we might go, and now we're going to drill down a little bit into the details and focus on the foreign tax credit. So let me introduce my fellow panelists. To my right is Dan McCall, who's currently a principal at Deloitte. Dan and I worked together in the government, among other places, where he was in the IRS for a long time, and so we'll have some government perspective perhaps on the foreign tax credit regulations we're going to talk about. To Dan's right is Diana Dvornik. She's a partner in New York City at Wachtell, Lipton, Rosen, and Katz. And then Paul Oosterhuis, who is of counsel at Skadden here in DC, and Gary Sprague at the end is a partner at Baker and McKenzie in Palo Alto. So the foreign tax credit, in hindsight, the first century or so of the foreign tax credit, which was enacted in 1918, was a relatively calm period of time in which kind of the standards for what constitutes a creditable foreign tax kind of evolved in a not too jagged way kind of over time, and ultimately crystallized around this concept in the case of an income tax of the predominant character test. So is the predominant character of a tax, is it a tax, an income tax in the US sense? So very, very high level. That relative calm ended in 2022 with the release of some final regulations under sections 901 and 903. Although there should have been a hint in 2020 when the proposed regulations were issued. People didn't, for the most part, get that hint, which we'll talk about. In any case, the 22 final regs really kind of, compared to what came before, represented a kind of a paradigm shift. And so we're really going to take, and I guess I should say now, they were short-lived. Like ultimately, although they're still on the books, only very narrow elements of them remain, which we'll also talk about. But in any case, revising those regs and kind of revisiting them remains a priority, or at least remains on the priority guidance plan of the IRS for tax regulations. And so we take that as a reason to, both examine the issues that were raised in those regulations and a way to kind of structure our discussion today, kind of following the structure of the proposed regs. So with that, I'm going to start by letting Dan talk about a little more about the history, in particular the recent history prior to those final regs being issued in 2022.
Thank you, Brian. So as Brian mentioned, we're going to spend almost all of our time focused on this topic of what should be a creditable foreign tax under Section 901 and 903, which are the main code provisions at issue. Before we focus primarily on that, let me first do a little bit of stage setting for why I think things unfolded a bit the way they did, and Brian alluded to this in terms of the preview of these rules, these regulations in 2020, and there were comments provided, but there was like a much more kind of significant response when they were finalized in 2022. So to set the stage, and as many of you are aware, in the last decade or so, not even a decade, we have witnessed like really significant changes to the foreign tax credit. And I just mean the foreign tax credit writ large. And I'm not going to give you an entire laundry list, but some of these changes have come in the form of legislation. And just taking through a few of these that we saw in TCJA, of course, we had the transition tax. There were complex foreign tax credit issues associated with the transition tax. We had, as kind of in connection with the advent of GILTI, we had the end of the old pooling regime and much more pressure put on what does it mean for foreign tax to be properly attributable to tested income or subpart F income. So that, was its own really complex, important topic. We had, again, as part of TCJA and this new quasi-territorial system, a disallowance for foreign taxes associated with exempt earnings under 245 Cap AD. The list goes on, just with TCJA and complex foreign tax credit issues that were both in the legislation as well as regulations that had to address those topics, which were, like front burner issues that Treasury and the IRS had to address in guidance. More recently, we've had some kind of follow-on legislation that, again, in the important issues in the foreign tax credit space from OB3, like interest expense allocation and apportionment rules under Section 904, additional kind of tinkering with the way GILTI or so-called necktie taxes are haircut or not. My point being, all of this activity understandably was a big focus on Congress as well as Treasury and the IRS in terms of implementing regulations. Sandwiched somewhere in the midst of all of the guidance that was needed to implement the international provisions of TCJA, I wouldn't even call it a breather, but there was a moment in time in which Treasury and the IRS issued these foreign tax credit regulations, which we're going to spend a fair bit of time talking about today, which don't really have anything to do with TCJA or this other legislative activity. The reason I kind of point out the dynamic, though, is I think there was a fair bit of guidance fatigue, probably in the tax community. There was so much guidance coming out, not just in the international, but like certainly in the international space, but even the domestic space, that, we're talking about like multiple rounds of like 100+ page documents full of guidance. And so the dynamic that Brian was alluding to, I think when the proposed regulations were issued in 2020, they did attract some comments, some critical comments, but it wasn't until we got the final regulations in 2022 that I think people really realized, and frankly, this is both like outside of government as well as inside of government. People really realized what the effect of the regulations we're going to have, and we're talking about like two features of these regulations in particular. One is the kind of introduction, or if you will, reintroduction of a jurisdictional nexus rule that to have a good credible tax, the foreign country needed to basically follow traditional norms for taxing the income at issue, and if it kind of ran afoul of that jurisdictional norm, the tax just wasn't going to be creditable. Another important feature is the so-called cost recovery requirement, which was kind of laid out a number of features that types of expenses that had to be recovered for the foreign levy to be a good net income tax creditable under Section 901. And so the rules got more prescriptive than they had ever been before. The kind of standard by which you determine whether the rules were met changed from kind of like the traditional way of analyzing the rules. All of this, I think, was done with a view that, a bit of a theoretical view that the rules were trying to identify foreign taxes that were taxes in the U.S., that were income taxes in the U.S. sense, and so they were trying to, by and large, describe rules that would be pretty similar to the U.S. system. And it wasn't until the rules were finalized that people really started scrubbing particular jurisdictions provisions, like you name it, whether it's in South America, Europe, Central America, Asia, like really scrubbing and like, well, what about this and what about that? And I'll stop talking here just a minute, but the dynamic, there was a lot of back and forth. When Brian mentioned that these regulations were relatively short-lived, there were, a number of ways in which Treasury and the IRS, I think, tried responding to the criticism, ranging from technical corrections, which by their nature could only move the needle like only a little bit, proposed regulations that tried softening the cost recovery requirement in one kind of aspect of the jurisdictional nexus rule when it came to licensing. It became it became clear relatively quickly that this was likely to be just an ongoing kind of back and forth process. And so eventually, Treasury and the IRS put out what was initially temporary relief in 2023, and one particular notice that was essentially kind of like, by and large, temporarily deferring most aspects of the rules that we're going to be focused on. And then not even long after that, Treasury and the IRS decided to essentially indefinitely suspend the rules. And so where we stand today is the Code of Federal Regulations has been amended. So if you go look through regulations under sections 901 or 903, you're going to see these very regulations that were criticized because, again, the regs have been amended. What most taxpayers are doing is relying on the relief in the Notice 2023-80 to, by and large, apply the old set of regulations with like minor exceptions, and the intended effect of this kind of like some of these narrow carve-outs is to try to ensure that DSTs aren't creditable. So that's where we stand today. As Brian mentioned, this topic is on Treasury and IRS's priority guidance plan. So that, whether this ultimately gets addressed through additional rulemaking out of the executive branch with Treasury and the IRS, or whether Congress takes up the topic at some point, I don't think we're going to focus too much of our time on that process point of like who does what and like in what format. Maybe we'll touch on it. I think we're primarily focused just on design choices and what types of policy choices rulemakers writ large might want to take into account as we move forward. So I'll pause there to see if.
And it is, to your point, it's a very uncomfortable place to be, right? Because, I mean, first of all, it's all very confusing. The fact that you have rules in a book and you have a whole other set of rules, which is effectively the set of rules that's not in the book, try explaining your international tax pledge that it's difficult. But the other point that I think is more important is now we're in this limbo, right, where this is all hanging together through a notice, which is something that could be easily changed at any time, which I think is what makes this very important and hopefully can be re-examined in a more comprehensive way than it was in 2020.
And even more importantly than that, explain it to ChatGPT.
That's right. Yeah. So yeah, let me step back a little bit and give a little more context and background so that we can dive deeper into the different aspects of the regulations and where they tried to focus. But kind of as Dan said, like the basic statutory provisions regarding the foreign tax credit are in sections 901 and 903. And these are about the creditability of foreign taxes, when you can actually, theoretically claim a credit for a foreign tax. We're setting aside all the other issues, Dan talked about, including like, even, for creditable taxes, the circumstances under which you can actually use the credit to reduce your tax. That's, a whole different set of more complex rules. So 901 and 903. 901 deals with income taxes, and 903 deals with in lieu of taxes. So taxes that are imposed in lieu of an income tax. So they don't have to be an income tax, but they have to, be imposed in lieu of one and meet some other requirements that are in the regulations. For the 901 income taxes, the test was historically, as we've talked about, is the predominant character of the tax an income tax in the U.S. sense. That was, ultimately fleshed out in 1983 regulations as based on three requirements. There was a requirement that the tax start with gross receipts, that it follows, some realization principles like U.S. realization principles. Basically, you take into account, your gross receipts or your gain at the time there's some event that justifies realization. Also, there is a net gain or a cost recovery requirement, so your gross receipts have to be reduced by the expenses, and that's how you get to an income tax. So what the 2022 final regs did was, a lot of things, but I think what we can focus on for our discussion today and generated the most discussion among taxpayers in the government when the regs were released are the cost recovery requirement and the attribution requirement. The cost recovery requirement, which was a traditional requirement for creditability under 901, was significantly tightened and basically in a way that the regulations could be read to suggest that unless a foreign tax allowed deductions for every significant expense, and there were a list of what were significant expenses, then it might not be creditable for anybody. So even if only a subset of taxpayers had some expense denied. Now there was some allowance for disallowance provisions similar to U.S. disallowance provisions like 163J for interest expense, but again, I think the range of disallowance provisions in foreign law is actually much greater. So, this created a lot of question about, are things like, the German trade tax really creditable? So that's, the cost recovery requirement. The other, more fundamental change to the requirements for being a net income tax was the attribution requirement, and this applied differently to taxes on non-residents by a foreign country versus taxes on residents of the foreign country. For non-residents, a foreign tax had to limit the income that was taxed by that jurisdiction based on some nexus, essentially. It had to be activities of the non-resident in the jurisdiction, an attribution of income based on a source rule, like a U.S. source rule, or if you had property located in a jurisdiction and you had gains from the property, that could be a nexus too. So having this kind of a nexus or jurisdiction to tax type requirement was completely new. Well, not completely new. There was something back in the original statute that quickly got changed, which we'll talk about. But this was an innovation, after more than a century of the income tax. In the case of the attribution requirement as it applied to residents of the foreign country, so like a French company in France, the main requirement was that the tax had to follow the arm's length principle, but not some other principle like formulary apportionment or some kind of market-based approach, as we were talking about on the first panel. So that's income taxes under 901. And broadly, we divided them into taxes on residents and taxes on non-residents. Now we're going to talk about 903 in lieu of taxes. So traditionally, as I said, to be creditable under 903, it had to be a tax that was imposed instead of a generally imposed income tax that the country had. The 2022 regs added requirements. One was that there had to be a close connection between the country not taxing you under the general income tax and taxing you under this hopefully in lieu of tax, and that might be evidence based on legislative history or something, but it was another factual kind of question.
With one exception, I think, which was for some covered withholding taxes. I think didn't have to meet that, but
no. So, but then this is the general kind of 903, and then there was also this jurisdiction to tax requirement, that had to be built into to the general 903 tax as well. Then, as Dan's saying, there was a special regime for covered withholding taxes. Now the way to claim a foreign tax credit under the final regulations is that it's a 903 credit. Like previously, there had been some question about, potentially you could credit on withholding tax under 901. Now, it's all in 903. And, again, and this is where a lot of focus was in terms of the headaches and questions from these regulations, was that the withholding tax essentially had to be imposed on income that was, foreign source from a U.S. perspective. Like under U.S. source rules would be something that the U.S. would consider to be foreign source, and that means different things in the case of services, which are generally U.S. source if performed in the U.S. versus royalties, which are foreign source if the IP is used in a foreign jurisdiction. But it created a lot of questions. I mean, I think that's kind of the overview of these regs. I would say, again, they created a lot of headaches for taxpayers. They were ostensibly aimed at certain like DSTs and extraterritorial taxes, but did a lot more than you would need to do ultimately to target DSTs, which are still not creditable. So, what that lot more did was, it ultimately make things a lot harder from an administrability perspective. One of Mindy's ChatGPT kind of outputs was a grade for the foreign tax credit on administration, ease of administration, and these regs, probably pushed it into failing territory on that. So.
Yeah, just like I think that was a great summary, Brian. The thing I'd add, just in case it's not clear, so you can see how when you apply the attribution requirement that Brian described, in terms of like the conditions in which a foreign tax needed to satisfy to be considered credible, you couldn't. The foreign jurisdiction wasn't allowed to tax based on customer location or market. That there was like the market jurisdiction. So you can see how it covered DSTs, but as Brian mentioned, it was certainly quite a bit broader. And I thought it was helpful just to kind of go back to where this was coming from in the proposed regulations, which was agree that it had the effect of addressing DSTs, but it clearly was written kind of more holistically, going back to that principle, which I think was behind both the proposed and final regulations, which was really trying to describe foreign taxes that were, taxes in the U.S. sense. And so I'll just really briefly read an excerpt because I think it helps to set the stage and maybe helps us appreciate whatever daylight there might be between the kind of conceptually pure versus the practical and what people had to kind of address in reality with, a litany of different foreign jurisdictions taxes. So the preamble says, as a dollar-for-dollar credit against U.S. income tax, hint, this is a big deal. The foreign tax credit is intended to mitigate double taxation of foreign source income. This fundamental purpose is served most appropriately if there is substantial conformity and the principle is used to calculate the base of the foreign tax and the base of the U.S. income tax. This conformity extends not just to ascertaining whether the foreign tax base approximates U.S. taxable income determined on the basis of realized gross receipts reduced by allocable expenses, but also to whether there is a sufficient nexus between the income that is subject to tax and the foreign jurisdiction imposing the tax. So it's picking up on both the two themes that Brian and I have been talking about, cost recovery and jurisdictional nexus or the attribution requirement is kind of behind this conceptually pure sense that really we should be trying to look for taxes that are a lot like our U.S. income tax, and that just ran headlong into real life fact patterns. And I'll pause there to see if you want to shift
This is a really important point because at the end of the day, it was really about base equalization, right? And you kind of think about that first blush, it has a lot of theoretical appeal because you're like, okay, well, the tax number will match the income number, and that just sort of makes sense, and that's kind of the tax that we should give a credit for. But it turns out, that's just like absolutely not how the rest of the world works. Nor is it really clear that that kind of theoretical purity is really you know, consistent with sort of what the goals of the foreign tax credit, as we're going to talk about in a little bit. But I think that is a very important point to keep in mind, which was if it's not like a U.S. income tax, then it's just not creditable because the numbers don't match up effectively.
Yeah. So with that, shall we go to the 901 part of it and focus on residents and continue to raise questions about both the arm's length pricing side of it, that income has to be allocated to residents based on arm's length pricing, and then the cost recovery part of it. And remember what Dan and Brian emphasized is that the way the rules work mechanically in the regs, they identify what they call a separate levy, and they use that term advisedly to not put the rabbit in the hat about it being a tax. And you judge each separate levy in its entirety, which means that if you have a single levy that has a defect in it, then it is no longer an income tax for everybody who pays it, notwithstanding the fact that the defect may just affect some of the people, some of the taxpayers. And so that was I think, a real problem with the fundamental design of some of these limitations, because first of all, as a legal matter, it would be hard for me to see a court. For example, let's say we had a country that didn't do arm's length pricing in some respects, and the government came along and said, therefore, your corporate tax is not an income tax. And somebody, a taxpayer who paid that tax, was not affected by the non-arm's length pricing, went to court to say, of course, you know, I should get a credit for this. I think that would be a case most of us lawyers here would take for the taxpayer, because it's pretty hard to justify throwing out the entire income tax because of its impact on certain folks. But the more fundamental question is why have the arm's length requirement in there in the first place? I mean, if India and Singapore want to get together and say, we have a tax treaty and we're going to agree to split income from services between the service recipient jurisdiction and the service provider jurisdiction, and we're going to do it based on a formula, and there's no double taxation, the result's just some taxed at the 25% rate in India and the 17% rate or whatever rate in Singapore, why would that not make it an income tax? I've struggled with that, really going back to the foundation of the proposed regs, because if countries decide to divide up the income, and they are dividing up net income, this is not a gross income tax, we're talking about a net income tax here, then why should you care which jurisdiction decides to tax it? Now, you can, and the same thing with market-based taxation, which is just, I mean, market-based taxation is just another way of, typically has to be formulary to get to market-based taxation. So if two countries decide to do that, what's wrong with it? Now, there may be a situation where one country decides to do it. India, for example, could have a significant economic presence test, and Singapore wouldn't. And then there'd be some double tax, potentially, because the income would be taxed in both countries. Even there, the question I would have is that a problem for the foreign tax credit regs, or is that a problem for something else in the foreign tax credit mechanisms if you care about it? I mean, it could be that there's a heavier burden of tax in that situation, certainly, if you have both a 17 and 25% tax on a portion of the income. But our foreign tax credit limitation can solve some of that. Now, with the overall limitation that we have in for NECT income these days, you know, it would go into the pot. For better or for worse, most taxpayers, I think we would think, are going to be in an excess credit position, so in NECT. And so it would be a real cost to them and a real discouragement if the countries didn't come together to try to figure out how to divide up the income. So it's just not clear to me that it's a problem the foreign tax credit regs ought to ought to try to solve to if there's inconsistent allocations of income between countries. But I'd be interested in anybody disagrees with that or has an elaboration on it.
Look, I think that's absolutely the right question. In my view, I don't think this is a foreign tax credit conversation at all, right? As we dig into this, we're going to start talking about, well, what are the arguments for market-based taxation? And then you stop and you think about it, and what does that have anything to do with the foreign tax credit, right? If you think about what the foreign tax credit is really about, right? It is about eliminating double taxation, right? Ensuring the US companies are competitive abroad, but also with a limit, right? Because we're not just crediting anything and everything, that's understood. But it does have this, the main point is eliminating double taxation. And given that the 904 fraction, the 904 limitation will protect US source income, right? And ensure that the US is keeping its primary taxing right over US source income. What we're really talking about with these regulations is exactly what Paul just pointed out, which is, does it matter what kind of foreign source income we're giving a credit to? And is it country A versus country B? And if we think it should be country A, but it's actually country B taxing, we don't give a credit? I mean, why? But even if you thought it was a problem, there are other ways to solve that, which is changing your 904 limitation, not necessarily changing what it means to be an income tax in the abstract.
Yeah, I would just say, depending on how, whoever the ultimate decision makers are on this topic, and again, whether in regulations or legislation, addressing it with 904 limitation, depending on how granular you want to get, could get more or less complicated. It's, I mean, a relatively obvious point, but I just want to point out there's still quite a bit of complexity in the 904 limitation rules. So I'm not disagreeing that it's worth considering that as the kind of tool that addresses this concern, but you could also turn the dial on how I guess granular you want to be in addressing the concern.
Right. Yeah, I mean, without advocating specific changes to 904, I think you could have a different type of complexity than you have with the final regs. The final regs required very fact-intensive dives into individual foreign taxes. The 904 kind of approach, creating additional baskets or something like that, could be just additional computational complexity. Now, it could also be factual if you have, part of the exercise is to figure out which income, is attributed to which per country basket or which, transaction-related basket, which are some of the, ideas that are out there. But, different kinds of complexity, potentially.
Right. Okay, let's move on to the cost recovery part as applied to residents. And as Dan and Brian were talking about, the final 2022 regs tightened them up considerably to say you had to allow all material deductions except the kinds of deductions we don't allow, basically, like 163J or we limit. And I got personally involved in that. We at Skadden were hired belatedly, I think the client would agree, to help them review the tax systems of about 20 different countries after the final regs to see what infirmities they had that could cause them to be their corporate income tax to be non-creditable. And virtually all of them had a feature that would make it problematic. Some of them were worse than others. And it's just because, and when you talk to practitioners in those countries, they can't necessarily articulate a reason why their law developed that way. It just developed that way. My favorite one to talk about is in Taiwan, you cannot deduct overtime wages. Okay, now maybe that's to discourage people from working hard. I don't know, but, and nobody in Taiwan could tell us why that's in there. Well, we obviously allow a deduction for overtime wages. So does the disallowance mean the Taiwanese corporate income tax is no longer creditable? I take that case on a contingency. I mean, of course it's going to be creditable. So you just ran into all these different things. And it forces you to say, well, what are first principles here? And it seems to me there's a couple of them. One is if revenue-based tax or gross income taxes are problematic, and that leads you to get into 903, but just stay with me for a minute. If there are some gross income taxes that are problematic, then you can have limitations on net income taxes that convert them to be closer to gross income taxes. For example, Colombia. Colombia has a limitation on deductions paid to non-residents equal to 15% of your gross income. Okay, so for a company that has a certain amount of, that has a lot of payments to non-residents, then this is related party and unrelated party. This is not, I mean, you can call it base erosion if you want to, but where the payments are to unrelated parties, using the term base erosion is, to my mind, a misnomer, because it's obviously arm's length if it's to an unrelated party. So you're not eroding anything, you're just reducing the tax base. But if, for example, instead of 15%, let's say Colombia did it at 70%, that you couldn't limit, or let's do the math differently, let's say 80%. Let's say Colombia has a 20% tax rate, but they limit your deductions to 20% of your revenues. Well, that really is like a 16% revenue tax, right? Because everybody has at least 20% deductions. And so you can see deduction limitations and disallowance converting a tax to be closer to a gross income tax or a revenue tax than a net income tax. And I can understand that as a problem for Section 901. What it should do, if you have those kinds of things, is then throw you into 903, because one of the things that made absolutely no sense in these regs is that if you failed the cost recovery, you didn't get a chance to then bounce into 903 to see if you met the requirements of 903, and you probably would have, because it was part of your income tax system. You just weren't taxing income. Instead, you were thrown out. And that didn't make any sense at all. So the first element of cost recovery is the disallowance of deductions or the limitations on deduction making the tax more like a gross income tax than a net income tax? And if it is that a problem? And in order to answer that, you have to understand what's going on in 903, and we'll talk about that later, because there may be some changes that folks think need to be made to 903 that could mean that in some cases, taxes that look more like a gross income tax than a net income tax are problematic. The second thing, and this also ties into 903, is disallowing deductions can be the equivalent of imposing withholding taxes when there are disallowances that relate to payments to non-residents. And in fact, there's a great example in Argentina. Argentina has a 35% tax rate. They have a 35% withholding rate. They reduced their withholding rate on trademarks in certain cases to 28%, but then they disallow 20% of the deduction for trademarks. So the two are the equivalent: lower withholding tax, but a 20% disallowance of a deduction, a 35% rate accomplishes the same thing. And so one of the things you have to see is if there are limitations on what withholding taxes are creditable, you might need to think about what deductions can give rise to equivalent revenues to that withholding taxes if they're disallowed or limited. And therefore, think from a foreign tax credit point of view, that's problematic. But if it's problematic, it can't be that the answer is to throw out the entire corporate income tax. It has to be what I call more of a rifle shot approach, which would be to just either make the taxpayer that it would really be to just disallow an incremental amount of foreign tax that you're paying by reason of the deduction, disallowance, or limitation. And in talking to the drafters of the 2022 regs, they did think about that, apparently, about a more rifle shot approach to disallowing, but didn't want to get into the complication of You know, how much extra tax are you paying in Argentina because they're disallowing 20% of your trademark deduction? And I can understand that, but if the disallowance of 20% of the deduction is a problem, you just can't solve that problem by throwing out the entire Argentinian income tax. You've got to solve it in a more micro-focused way, it seems to me. But I do think in a world where some withholding taxes are not going to be creditable, and again, we'll talk about that a little later, you might need to think about targeted rules to disallow credits for residents where their deductions for payments to non-residents are being disallowed.
If you care, or you could just let the 904 limitation deal
Exactly,
with
because
it. Like,
you
I
could.
mean,
Because in the simple example, when you're just operating, say, in that one jurisdiction, you get the answer that you want just through the operation of the fraction, right? It's only when you get into multiple jurisdictions where you can say, well, maybe this isn't right, but again, that's a cross-crediting question.
Right, yeah.
Right.
But if you take the 904 limitation as a given, that it's going to be overall and not per country, and with some of the allocations of income being done not by arm's length pricing, which is how we would measure a per country limit, it kind of makes sense to have an overall limitation, because otherwise you're going to, you know, your limitation is going to kind of artificially keep you from getting as much credit as you should get.
And there was a reason we made the decision to go to the overall limitation.
That's right.
Don't get me wrong, I'm not arguing against it. I'm just trying to illustrate that this is just the sort of getting at this through the definition of income tax is just the wrong question, it seems to me. And I mean, to build off what you were just talking about, Paul, I mean, in some sense, right, denial of deductions, even in that sort of scenario, it's like, where is that different than just having a higher rate, right? That's also not always entirely clear what the distinction between those two things is. And having a higher rate, no one has ever suggested would be a problem.
If we don't have a problem with withholding taxes on outbound payments being creditable, then deduction disallowances for those payments ought to be fine too, I agree. If we do have a problem with withholding taxes, like if it's a withholding tax on imported goods, for example, then we might have a problem with deduction disallowance.
If I can add something to Paul's story about Skadden having to look at 20 countries around the world. When these regs were first imposed, it seemed to me clear that this was going to put a huge burden on taxpayers to go figure out the laws of any number of countries around the world. So I actually suggested to the people working on the regs, look, you gave us a list in the check the box regs of all the per se entities for every country in the world. Just do that here. Give us a list of those countries where deduction denials or whatever it is makes their corporate income tax non-creditable. And the reaction was, that would be too hard. Okay? And so the answer to that is, yes, it is hard, but now every taxpayer in America has to do that instead of the government giving us a list.
And in fairness, I mean, the prior standard was predominant character, right? And that's subjective, and that raised problems in some cases. One could even argue that the Columbia limitation I talked about could be large enough to make you think about whether the predominant character is an income tax. But let's face it, it's a standard that most of us in private practice have said, no, if they call it an income tax and most people are paying it on their net income, then predominant character is not an issue. It's just when the government gets into a particular case, like the PPL case or maybe a few other cases, the predominant character test was kind of squishy, and they wanted to get away from that. But I think what they found is that you just can't get away from it.
Yeah, I'll just say really briefly, I think administrability, as you're seeing, is like a huge part of the kind of decision-making matrix here. And the example that Paul mentioned, I can't swear to this, but on an example like Colombia, there were proposed regulations that were kind of dialing back the cost recovery kind of strictness and making it, a bit more lenient. And I just point that out that, like, even if, that hit the mark in certain cases, it was still going to require companies, taxpayers, and in theory the government to still scrub foreign law in a way that tends not to happen in the predominant character type standard, or the what we generally are under now if people are applying the relief from Notice 2023-80. So that type of administrability kind of calculus is like, I think, a really important one for figuring out where we go from here.
So maybe should we switch now to non-resident taxation under 901? Is that?
Sure, although, in some sense, it's a good distinction to have, but really all these issues are ultimately interrelated, resident, non-resident, et cetera. But maybe in the context of non-residents, non-resident taxes, really, the question of jurisdictional nexus really becomes, comes into play, and it becomes evident how constrictive it really is. So as Dan was describing earlier, right, the jurisdictional nexus for non-resident taxes was basically, this tax must be imposed one of three ways. PE principles that are just like US principles and do not take market factors into account. Sourcing rules, such as the US sourcing rules. And the third was, real estate investments, so something similar to how we deal with real estate under FERPTA. And maybe just to take those in turn. When you talk about PE principles and this prohibition that it cannot take into account any market type factors, I mean, the debate that you're opening up is this big debate of our time, which is, should market factors really be taken into account for purposes of income-based taxation, and is that just an appropriate approach to international taxation in this new age of the digital economy? And that really, as I was saying before, it doesn't really have anything to do with the foreign tax credit, right? This is an international tax big picture question. And if the resistance, which I think part of it was, right, was animated by DSTs and the concern that these types of taxes would proliferate and therefore harm US companies, why is the foreign tax credit system the appropriate way to do that, right? There are other alternatives, such as, international cooperation, perhaps, disallowance of specific taxes, or imposition, something like the revenge tax, right, that we almost had for a second, where if your goal is to cause a different country to back off from a particular policy regime, there's got to be a better way to get at that than to impose additional taxes on US companies operating in that jurisdiction, right? It's not at all clear that doing that is going to cause the foreign country to change its ways while harming the sort of very companies that we're trying to protect. So that part of this whole regime never really made a ton of sense to me from that perspective. And then, maybe just to quickly talk a little bit about some of the sourcing equivalence rules, and why that also never made any sense to me, is that in many situations, our sourcing rules are actually the outlier, not the international norm. Really good example of that is royalties, right? I think there are very few countries that, like us, look at the place of use and the IP law overlay and penumbra that protects the IP rights in question. Most countries look at other factors, such as where is the deduction for these royalties being taken as an approximation, right, where that royalty is actually being used, as opposed to this sort of like IP rule. Others look at the residence of the payor. And so if you're really going to focus on some of these US principles to deny the tax credit, it just can't be, and say that you're doing it because you want to get back to established international norms. You really can't do it if we don't follow the established international norms. And the other point I would make there too, like in a lot of those cases, our rule and another country's rule could lead to the same answer. So why the heck should it matter that the other country used a different rule to get to the same place? And why should that deny a credit for the entirety of this tax? So I think those are the kind of issues that you run into when you just try to adopt this very US-centric view to the foreign tax credit. Another very good example of where our sourcing rules are really weird is sales of purchased inventory. I mean, the title of passage rule, I don't know that anybody else really does that. And it's notoriously easy to manipulate, and to require conformity to that particular sourcing rule just doesn't really seem right. And frankly, we should probably think about changing our own. And then, I'll just end with this and we can move on to 903. Sorry, Gary. The services were another example, and that was these regs would have affected a lot of service taxes in many jurisdictions because a number of jurisdictions impose withholding taxes on services that are performed outside of the relevant jurisdiction. And you can break those down, I think, into two categories, right? This comes up a lot with these technical services, which are definitionally services that don't just include a service, but also some sort of a transfer of a know-how. And that, to me, is a very gray and difficult area to parse, right? Because it's not always clear, is this really a service or is this a royalty, in which case you would get completely different answers. So just to kind of circle back all around, like when you look at these individual rules and how they apply, you sort of realize that this isn't really a sustainable system. And if we acknowledge that at least one of the objectives of the foreign tax credit is to limit double taxation, this just feels like an overreaction in kind of the wrong direction to me. But I don't know if folks want to add anything to that.
No, I totally agree that our source rules are peculiar. There's no question about it. Some of you know Gary's the U.S. reporter on the topic of royalties for EFA this year. I'm one of two general reporters on it. And Tiana is right. The way we treat royalties under the 1980 revenue rulings based on where the IP is used in an intellectual property sense is not the general rule internationally. It is either where the jurisdiction you're deducting it or the jurisdiction you're paying, or which often overlaps. And really, when you think about it, our rule doesn't work for royalties because it gives rise potentially to cascading royalties. It also gets into the nuance of IP law, of when do you really need a right in order to, for example, sell a product that has a patent design behind it, and it just doesn't work. And one of the things that I think would be a nice project for the service would be to go back to the drawing board on those 1980s revenue rulings and say, let's conform to international norms and have our sense of use be use by the licensee, not use in an intellectual property sense. So I always give the example, if you're Ford Motor and you're manufacturing Ford trucks in Argentina and selling them around South America, you need the trademark rights and maybe other IP rights for all of those countries. So when you're paying a royalty back from Argentina, technically all the South American countries should be imposing their withholding tax on it if they had our rule. And of course that's impossible, it doesn't happen. And yet that's the consequence if everybody adopted that rule. It's just not workable.
So Paul, you note that the US rule is not the common rule. Is it unique? Is there any other country in the world that has that rule?
Yes, there actually are 3 or 4 others that follow it to some extent. Now, they probably follow.
But to some extent, there's probably none.
They probably follow it in the breach in the sense that they don't impose their withholding tax on a transaction between 2 non-residents, even though their IP rights are involved typically. Germany has some exceptions to that, as you probably know better than I do. But there are very few countries that follow that use rule, and those that do probably follow it as much in the breach as they do as a strict rule.
So we should talk 903 before we end, Gary.
Okay. So we're going till 4:30, hopefully with some time for Q&A. Right?
I think do we end at 4:15 and then we have 50?
A couple minutes, so yeah, it's about 15 minutes left, so leave some time for Q&A.
So let's go to Gary with wholding tax.
And raise your hand if you have a question.
Yeah, absolutely. So bringing up the rear here is withholding tax. So we've had the foreign tax credit system for a long time. Why after 100 years are we suddenly thinking about the creditability of withholding taxes? This is clearly a reaction to developments outside the United States. And so My comments here will not just be technical comments, but quasi-political comments as to whether the U.S. foreign tax credit system ought to be a foot soldier in whatever campaign the United States wants to wage against these OUS developments. So, but level set on the credibility of withholding taxes, as you heard earlier, a withholding tax, if creditable, it's under 903 as an in lieu of tax. And 903 in lieu of tax has two different branches. One has a fairly complex substitution requirement, where the in lieu of tax has to have a close connection to the generally imposed income tax. The withholding tax, the covered withholding tax, is actually relatively simple compared to all the other definitions of what can be a creditable tax. It's a tax on gross. Interestingly, it doesn't have to be enforced by withholding. It's just a tax on gross, which opens up the possibility of taxes like significant economic presence taxes, if imposed on a gross basis, being creditable. And it can't overlap with another tax. So it's a pretty simple technical definition. My comments are going to focus on withholding tax on services. Around the world, including the United States, there can be withholding taxes on lots of things, but the activity outside the United States that is creating the most angst is countries imposing withholding tax on services. And why is that? Because they're very expensive. Withholding taxes on gross are always more expensive than taxes on net. Here, we're not presenting a very good example to the world with a 30% withholding tax. It's hard to see any policy reason for our gross-based withholding taxes being more than the normal 21% rate, but since that's a tax being paid by the foreigners, maybe we don't care about that. And it's expensive to the US FIS too, because if we allow a credit for all these gross-based taxes, that's a very expensive drain on the US Treasury. So what's happening around the world? There's a clear push by many countries to impose more gross-based taxes on sectors that are important to the United States. We'll just take the work of the UN as kind of a microcosm of the Energizer Bunny source of lots of ideas. They started out by trying to push all software payments into the category of royalties subject to withholding tax, and this is all software payments, not just software royalties, but software payments that we, under our -18 rules, would consider to be payments for copyrighted articles. So that was step one. Then step two, committee of experts puts into the UN Model Treaty payments for technical services subject to gross basis withholding tax. Then comes Article 12B, gross base withholding on all payments for automated services. And now Article 12AA, gross base withholding taxes on all services, right? So you say, well, what does that really mean? The UN Model Treaty doesn't mean anything, it's just a model treaty. But I do think that it has contagion effect possibilities and that it can be used by some countries as setting forth an internationally, in some quarters, accepted standard to increase withholding taxes on gross payments. And all four of those points that the UN has decided to put into the model treaty as justifiable gross-based taxes, how are they different than withholding taxes on dividends, interest, and real royalties? They're different because they're payments on real business income that's generated only because you have real business expenses, development, creation, delivery, customer support. When you move withholding tax away from the pure revenue streams, pure income streams of dividends and interest and old-fashioned royalties, the withholding tax on real business income is really an animal of a different character. So everyone can agree, I think, that growth of withholding taxes on fully loaded business income is a problem. And now we come to the question for today is, what should the United States do about it and should in particular the foreign tax credit system be, as I said, a foot soldier in this war. So let's start with the fundamental purpose of the foreign tax credit. We heard earlier today in the first session that the fundamental purpose of the credit is to avoid double taxation. Pretty simple expression there. It's also to encourage, or at least not inhibit, the ability of U.S. multinationals to do business overseas. I do think that it is in the interests of the U.S. tax system to encourage U.S. multinationals to expand into foreign markets. U.S. businesses have had great success operating outside the United States, and that ultimately redounds to the benefit of the U.S. economy. On the other hand, the system has to protect the U.S. fisc, and as Tiana mentioned, that is where 904 comes in. 904's express purpose is to ensure that the U.S. retains all taxing rights over U.S. source income. And the question for discussion here is, well, maybe 904 itself could be an adequate backstop, even in light of these additional taxes appearing outside of the United States. So we have noted the business trends that are creating the tension. We've noted the basic principles of what is the foreign tax credit system meant to do. So now let's put the question on the table, well, should there be anything done about 903 rules on withholding tax on services in particular, because we don't like this development of more withholding taxes outside of the United States. So what could the justifications be? And these justifications, all would go into the question of whether the in regs but now suspended attribution requirement is an appropriate rule. So one possibility is to dissuade foreign governments from imposing these sorts of taxes. Now there's some, Argentina was mentioned, that have had gross-based withholding taxes for years and years and years. There are others that are relative newcomers to the game, saying, well, we kind of like the idea of withholding tax on digital service payments. And so if I'm Malaysia, for example, maybe I'll enact a withholding tax on digital service payments. So query, is restricting the U.S. Taxpayers' ability to claim a credit going to change government behavior? I think it's pretty unlikely that the Malaysias of the world would say, oh, Congress or the Treasury has just made it more difficult for U.S. digital service companies to claim the credit. Therefore, I'm not going to impose my tax. I think it's much more likely that foreign governments are looking at the revenue potential, maybe looking at lots of other things about whether this tax is a good thing or a bad thing. But the fact that claiming a credit is going to be more challenging, I doubt will enter into the calculus of many of them.
It's interesting though, Gary, the digital services taxes are not eligible under 903 because they're not in lieu of taxes. And indeed, in many of the foreign countries, they specifically labeled them as not income taxes because they didn't want them to be covered by their income tax treaties, which would have prevented them from imposing them on treaty partnered companies. But it's kind of a formality, isn't it? The way we discern today a non-creditable revenue tax on services, digital services tax, from a creditable tax. It just is, if they call it a withholding tax and put it in the same chapter as their income tax, then the old regs make clear they're creditable because they have example of services withholding taxes in the old 903 regs that are now effective. And does it make sense to have the line be that formalistic so that if a foreign country wants to impose a tax that gets revenue from U.S. companies, but the companies don't have to bear the full cost because Uncle Sam will give them a credit. I don't know. I mean, it seems like it's a, I mean, remember when Puerto Rico did that with its excise tax? It did it only because they could get a credit. I do worry that some foreign countries, seeing that most of the service providers whose revenue they want to get are US companies, might intentionally design them to be within the meaning, within the realm of 903 and not within the realm of the UK and French digital services tax.
Yeah, that could be. It's also clear that there's lots of line drawing that we always have to do. Withholding taxes can operate sort of like tariffs. That was mentioned in the first panel today. So we're always drawing even under existing law, we're always drawing lines between a withholding tax and an excise tax or a tariff or DSTs. The not technical argument, but the policy argument why DSTs should be creditable is that there's no doubt that that was an attempt by France first, other countries later, to move some of the tax base of US companies from the United States to France. So if you look at it that way, it looks like an in lieu of tax that should be creditable. But they did design it. The way they designed it was consciously trying to stay outside of treaties and also to avoid charges that is totally discriminatory against US companies by making sure at least one French company was a DST taxpayer. But and I don't know whether this was conscious, but where they fell afoul in making it creditable was by imposing it on French companies too, in principle, because that violates the substitution requirement for 903.
No, that's true.
So I think the reason they made it applicable to all taxpayers was principally focused on non-discrimination things, but by accident, they made it
I agree.
But you can see why trade policy ended up being the primary lever against DSTs, because I mean the more narrowly targeted these foreign taxes are and kind of aimed at mainly US companies, the more it really looks like a trade issue than a tax issue.
Okay, since we're running late on time, let me finish my list of possible justifications.
Sure.
Then I can get to the punchline of what should change be, if any. Okay, so we talked about dissuading foreign governments, and maybe foreign governments say, yeah, you can credit it, and that gives them some green light, but I don't think that's going to be the case in most cases. The other is to change behavior of US taxpayers by making it too expensive to operate in Argentina. Does that mean companies won't pay as much Argentine tax? The problem with that is that there are behavioral changes that US companies can make. But for example, if you're paying a lot of withholding tax in Asia, the behavioral change might be to move your operations to Singapore or sell into Asia from the Netherlands, places that have better treaty networks than we do. So there are ways to reduce the tax that are inefficient from a business perspective, because if you hadn't moved your operations to Singapore because it made sense from a business perspective, but only do so because of the US foreign tax credit rules, there's obviously a leakage there in terms of business efficiency. So third possible justification is, well, maybe if we turn the screws on US multinationals, they'll find some way to pass on these costs. So that happens. US companies have tried to use gross-up clauses for years and years and years for sales into some jurisdictions, into many African jurisdictions, into many Latin American jurisdictions. It's kind of normal practice. The customers there expect it, but it increases the price of US goods and services by 20, 30%. So it's not something that
But doesn't that constrain the country then in terms of imposing the tax if they know that it's going to be passed on to their local citizens? It becomes an excise tax, right?
Yeah. So it's kind of it's another way of looking at that first possible policy goal of causing the government to change behavior.
Right.
Do governments really think about this much when imposing the withholding tax? Don't know. Possible fourth justification, just limit cost to the US fisc. You know, so that's a policy justification. Does it really justify making a change only to the creditability of withholding taxes on services? Don't know. Maybe it ought to be something in 904 overall to make it a more equitable limit instead of applying disproportionately to those sectors that have withholding taxes on services. So finally, the last justification that I put in the paper, you know, we don't like this tax. So we can all agree we don't like the tax. Is that a policy reason? You know, it could be a policy reason to get out there and, you know, advocate in international fora to not have taxes of the sort that we don't like. So I got 3 minutes, so let me get to the end. If those are the justifications, possible justifications, and as I went through those, I commented why they don't really look like compelling justifications to me. The most compelling reason for not adopting the attribution rule, not readopting it, not bringing it back into effect, is that any of the limits that limit the ability of the US multinational to claim a credit imposes the cost on the US multinational. So why should the US business be kind of caught in the middle of this debate between the United States, we'll call it France, the United States and France over how to allocate the tax base among countries? Congress many years ago adopted our credit system. We have a credit system. We don't have an exemption system. That would be an alternative. Scrap credit, go to exemption. That would fix all this. But I do believe that the battle over this allocation of tax base ought not to be done on the back of US taxpayers, but through other mechanisms that the US government can pursue. And obviously, there's no magic wand here, but treaties. You know, it's still a sticking point that our treaty network is just not nearly as well developed as it could be. You know, the reason Singapore is a favored location in Asia, one of the reasons, they have much better treaty network there than we do. So treaty development would be useful. The opportunity to participate in any multilateral discussions is important. You know, we're not going to win any votes in the UN. We're always going to be outvoted. But having the United States be vocal there and be recorded as describing what we think the appropriate allocations of tax base internationally should be, I believe, are important. Maybe a more remote alternative, 12B, you know, does have a net-based tax option. You know, the taxpayer can choose. You pay withholding tax on gross or prove up what your net is. That's a better choice than just paying withholding tax on gross. And trade agreements. It was mentioned earlier today that the trade people and the tax people, you know, don't socialize in the same clubs. But trade agreements, to the extent we're able to enter into trade agreements with countries where we don't have tax treaties, maybe we can find a way to sneak in some tax principles there. So that's my view of the kind of geopolitical environment and how they ought to be impacting Treasury's decision on future life, if any, of the attribution rule for withholding tax on services.
Thank you. And I think we've mostly run out of time, but Indy, go ahead.
Are you guys suggesting legislative solutions or regulatory?
Well, that depends. I personally think if the service wanted to disallow credits for withholding taxes on services, they'd have a hard time given that they moved withholding taxes into 903 and out of 901 back in the 83 regs. I think that was a mistake. They should have left withholding taxes under 901 and just said it's an exception for certain traditional withholding taxes, but not for other withholding taxes. So I think they have a hard time. I think if you're going to deny credits for withholding taxes on services, you probably have to do it legislatively. And while you're at it, I would think about what we do with royalties too, not just our source rule. I think they could change the source rule on royalties by administratively, because it's mostly in revenue rulings. The definition of the word use Doesn't have to be IP use. It can be use by the payor.
Yeah, I think it would be useful to comprehensively think about both royalties and services from a legislative perspective, both sourcing and 904 in light of, the increased source-based taxation. And maybe you take some sort of split the baby approach or something that Treasury can't do, but Congress can.
So far, we're largely agnostic in the paper in terms of like what path, who's making the change. We could get more specific, although, I don't know.
I mean, and let's face it, withholding taxes on services would be a problem for the companies and not for Uncle Sam, because the services don't produce any foreign source income, right? When they're taxed through withholding, they're non-resident, and so you have to have other income to use the credits, right, Gary? And so what is that other income? It's other general basket income. And it's most likely royalty income. And so that raises the question of, should we be separating baskets somehow?
Well, and that's, why you have to think about royalties and services
Or
together.
the proposal that the paper for the AEI conference 2 years ago made, which I thought was somewhat interesting, which is to have a reverse resourcing rule applicable to treaties, that where treaties get rid of the withholding tax on royalties, you then treat that royalty as U.S. source income because the treaty is giving us the first right to tax it. And that would largely solve the problem, because if there's a withholding tax on services, the main thing you have to credit it against is royalties that you get from countries where you're not paying withholding tax.
I guess you'd still have royalties from non-treaty jurisdictions, but it would go, it would
Yeah,
fix
but
the problem
they
somewhat,
typically
yeah.
have withholding taxes associated with them, so you can't offset them with excess credits from
Right,
services. Yeah, I got to tell you, Gary, tell me, I mean, we're spending hundreds of billions of dollars on AI models, right, on the data centers and everything, and that's going to be a service. And all of that's being expensed. So 4 years from now, when the revenues start coming in buckets as the market is expecting them, and these foreign countries start imposing 10% withholding taxes on them, if they're creditable, the U.S. could find itself in a position politically where there's some blowback, because the deductions have reduced the U.S. revenues, and now these withholding taxes are offsetting a significant portion of the income.
But if they're services, though, isn't it U.S. source? That's what I struggle with.
They would
I
need-
mean, yes,
Yeah,
there's
they have to be
cross-crediting,
able to
but
cross-credit. They have to.
They-
You're
they
right.
would
They
need
have to be able
royalty
to
income,
cross-credit.
and not
I'm
all
just
of them
saying
do.
there could be some legislative activity because of the potential mismatch.
That shows the U.S. government needs to get out in front of it and make sure that there isn't much withholding tax on AI services.
But I got to tell you, the business community has to get behind it as well, or the government can't really do a lot. We saw that in Pillar 1, right, where the government wanted to do something about digital services taxes, took the Pillar 1 approach, didn't get any support from the business community, and therefore Congress was against it, and so we didn't go along with it. You don't want to have the same thing happening again.
With that, we get to move on to our next.
All right.
Thanks.
Okay, I think we can get underway. Thank you all for joining us. I'm Philip Wagman from Clifford Chance in the New York office, and I'm very glad to be talking here with my fellow panelists about the CFC rules. I'd like to introduce to my right Kara Mungavin, from a partner at Davis Polk in their New York office, David Noren, a partner at McDermott, Will & Schulte here in Washington, and Rachel Kleinberg, partner at Gibson Dunn in Palo Alto. And we thought we'd divide our discussion up into three main pieces. First off, taking a step back and looking at whether this might be the time, or whether we might be approaching a time that would be right to make bigger changes to the CFC regime. And in particular, we'd start by looking back at the 2017 and 2025 legislation and seeing whether we could discern a direction of travel that might lead to bigger changes in the CFC rules, potentially including having sort of two basic buckets of income, passive income and non-passive income, and conforming possibly within each of those buckets rules for netting and carry forward of losses, as well as the foreign tax credit rules applicable to each of those buckets. We also would take a new look at E&P and its role in the CFC rules, and how much, if at all, it needs to be retained, and also the interaction between domestic losses that a shareholder may have and the shareholder's income from CFCs. So we have thoughts on bigger picture changes that could be made, including in those areas. And we'll take roughly half our time talking about that. We then thought, being somewhat realistic and figuring Congress would probably have to intervene to get a lot of that done, what are smaller changes that might be made while we're waiting for perhaps more systemic revisiting to the CFC rules. And in particular, we're going to look at active categories of foreign personal holding income and Section 956, and whether we could limit or eliminate those two categories of rules. And last, and that'll take probably about a quarter of our time. And last, we'll look at the interaction between the US CFC regime and Pillar 2. We'll try to analyze whether the changes that we've spent time describing would impact the continued ability of the US to fit within the side-by-side safe harbor. And we'd also look at whether those possible changes to the CFC rules would mean it's more likely or less likely that the US should or would want to try to adopt any pieces of the Pillar 2 regime into domestic law. So a lot to talk about, and maybe we'll start by talking about the big picture look at the possible reboot of the CFC regime, and Kara will kick us off.
All right, thank you. And thank you all for being here. So it's a big topic, as Philip mentioned, reforming the CFC regime. And I will say, thinking about where to begin, I like to begin with a little history here. And that's because if we're going to suggest changes, and potentially sweeping changes, then I think it's important to understand the system as it exists today, which means we have to understand why we're here and kind of how we got here. So I'm not going to dwell on the history, but I just want to put the current system kind of in context. And so if we think way back to before 1962, the US international tax system was a worldwide system of tax. And so if a US taxpayer generated earnings offshore, they were taxed. If they generated the earnings directly, they were taxed as and when earned. And if they housed their foreign operations in a foreign subsidiary, then they were deferred until repatriation. And that's kind of how the system worked. They were not taxed until the foreign subsidiary either distributed a dividend or was sold. Now, what that meant, though, was that the taxpayer, the US shareholder, had control in many cases. If they were a controlling shareholder, they controlled the tax event and the timing of the tax event. And Congress started to worry that with that control, what that meant was that taxpayers could shift categories of income that were sort of easily mobile categories or easily moved mobile categories, in particular passive income, and defer that tax on that income indefinitely. And so in response, Congress enacted the Subpart F regime. And of course, what the Subpart F regime provided an exception to the general rule of deferral. So if a US shareholder was a US shareholder of a CFC, so if they own 10% or more than 10% by voter value of a foreign subsidiary, and if the foreign subsidiary was more than 50% owned by voter value by US shareholders, then each US shareholder would be taxed currently on Subpart F inclusions. And essentially what Subpart F did was undefer the tax that would otherwise have been deferred until repatriation. And so it was really an exception to the general rule. And that, viewed in that way, that explains a lot of the design choices that Congress made back in 1962 about how that tax would be imposed, right? It explains why Subpart F inclusions are limited to E&P, right? Because if the earnings in question or the income in question was actually distributed as a dividend, it would only be taxed as a dividend to the extent of the company's earnings and profits. It explains why CFC income or Subpart F income is determined on a CFC by CFC basis, right? Because dividends are determined on a CFC basis. You don't blend from all countries. It explains why you don't have loss netting from one CFC to another, or from one period to another. You don't have carry forwards or carry backs. Now, of course, the E&P limitation did serve a little bit of loss netting and carry forward and carry back function. Just if you have losses in the same company where it has Subpart F income, then of course those losses depress the E&P and potentially shelter some of that Subpart F income from being taxed. And of course there's qualified deficits, which can smooth out some of the inclusions year to year. But the general principle was no netting in either of those ways. Now, of course, that was the system in 1962. That persisted for over 50 years, and then with changes here and there. But we saw a vast change in 2017 when Congress enacted the Tax Cuts and Jobs Act. Under the new regime, we had Congress enacted a participation exemption, right? We had Section 250 that says when a shareholder, a 10% owned foreign corporation distributes a dividend, then there's a participation exemption for, or a deduction for the US shareholder. But it also enacted the GILTI regime. And so GILTI taxes on a current basis, sort of like Subpart F, but not exactly like Subpart F, most other categories of income. So most categories of active income. There are various exceptions, but once the regime was enacted, between Subpart F and GILTI, most of a CFC's income was taxed on a current basis to the US shareholder. And so there was no longer a general rule of deferral and then exceptions for categories of income that Congress viewed as highly mobile. Instead, the general rule, to the extent there was one, because the two systems kind of don't mesh very well, but the general principle was really that US shareholders would be taxable on a current basis on most of its CFC's income as and when it was earned. Of course, GILTI was a little bit of a misnomer in my view. It's global, yes. Intangible, well, it's only intangible to the extent you think that QBI, or the net deemed tangible income return, was a reasonable proxy for tangible income, right? Because that was netted out of aggregate income. And so if you take aggregate income, you net out a proxy for tangible income, you should be left with intangible income. However, that QBI proved to be a poor proxy. But we're not going to dwell on that here because that's all gone. Last year, of course, with OB3, Congress acted again and made some changes to GILTI, including changing the name. Now we have necktie. So we don't have QBI anymore. We don't even have any sort of it's not even described as a tax on intangible income. Of course, when GILTI was first enacted, it was described in the legislative history as a tax on intangible income, and it was in response to concerns Congress had about intangible income being easily mobile, sort of like Subpart F. But that's all gone today because now GILTI picks up pretty much everything except a handful of categories. Low tax, that was also part of the name, low tax income, and that was accomplished both through the high tax kickout and through a foreign tax credit. And I won't get into the details now, but the foreign tax credit has become more generous. I think it was pretty clear that up until the changes that were made last year, GILTI did not just target low tax income because income could be taxed in a foreign jurisdiction, but then the foreign tax credit limitation regime could pull back the ability to use the foreign tax credits, and therefore GILTI could be imposed on income that was taxed at a higher effective rate than the legislative history suggested of 13.125%. But of course, Congress changed that last year, and now we don't allocate expense and most other deductions or expenses to the GILTI basket. And so the necktie regime is much more actually of a full inclusion regime with a foreign tax credit. It's closer to a top-up tax, I would say, but it's much closer to a full inclusion regime. But the point remains that we now have two systems, right? If you have a CFC, if a US shareholder has a CFC, they have categories of income that fall into the Subpart F income basket, they have categories of income that fall into the necktie basket, or the tested income basket, and then there are separate categories of income that are taxed differently, but the two big categories are Subpart F and GILTI. And those two regimes, the income inclusions from those two regimes, are calculated in vastly different ways. And I think one of the topics that we at least find very interesting is why? What explains the design differences? I mean, I think what I've just gone through kind of explains historically why we got here, but it doesn't explain why we're staying here. Inertia is, of course, a factor, and complexity, and the system is going to be complex no matter what, and we have a system that we are familiar with the complexity today. But that's not really a good reason to keep the system around forever. And so I think what we want to explore is, should we be eliminating some of those differences, or many of those differences? And if so, which differences would we eliminate? Where would we go from here? And I think one obvious place to start is the E&P limitation on Subpart F income. That doesn't exist for GILTI, but Subpart F income is limited by E&P. I think I'll open it up to comments from my co-panelists, but I don't think that makes a whole lot of sense. I think that, as I noted before, it does serve some important practical functions. I think if you eliminated the E&P limitation, you could potentially see income inclusions go up in a way that wouldn't necessarily be appropriate, because I think there is a little bit of loss netting. And so I don't think you can look at that change in a vacuum and say, what are we doing here? Why is E&P still a factor? I think if you make that change, you then have to consider other changes that would sort of flow from there. So then we have to look at, why is Subpart F calculated on an entity-by-entity basis? Should we be allowing some netting across CFCs like we do for necktie? Right? In necktie, you have tested income and tested loss. It all flows up to the US shareholder, and you have some netting there. So there's some loss sharing. Should we have loss sharing year to year? Right? I mean, if we have a full inclusion regime, then we are potentially comparable to the domestic regime, and it's notable that we don't put so much emphasis on the unit of accounting in the domestic regime. You have loss carry forwards year to year to sort of smooth that out a little bit. Obviously, doing that for GILTI or necktie or Subpart F would be very, very complicated. But I've talked a lot, so let me.
I don't know if it's that complicated. So,
okay.
And maybe starting with the first question on E&P, like, to me, E&P is about distributions, right? I mean, that's what it is in the domestic context. If you have a full inclusion system and you're just then exempting everything that comes out, like, yes, we're going to have to deal with how do we basket losses and credits and at what level we determine them at. But I don't see any good reason for E&P, with one exception that we talked about. But for almost all of this, right?
I agree.
Why does it make sense?
And just to add one thought, I mean, you can see as you alluded to, perhaps a historical reason, which is sort of what I might call a family resemblance reason, that perhaps when Subpart F was originally enacted, the idea was, well, we tax shareholders, including US shareholders of non-US corporations, on dividends. And everyone agrees that that's okay. And all we're doing now, which don't worry about constitutional or other concerns, is we're just accelerating. We're not allowing you to artificially sort of defer the time at which a dividend might be paid by shareholders who, either individually or together, have control over the foreign corporation. So you could see in that context, sort of perhaps like a historic rationale for introducing the concept. However, sort of fast forwarding to the last 10, 15 years, it sort of seems like the CFC regime has moved on from that concept and that way of thinking, and is sort of saying, CFC, it's sort of a type of flow-through. Because we like things to be complicated, it's not just like other types of flow-throughs in the code, it's its own type of flow-through, but it's so.
Right, I agree with that completely. I mean, it's sort of, another way of saying it is that Subpart F represented an exception to a general rule, but the general rule has changed. So to me, it's not that logical to leave the exception intact when you change the general rule. Now, but again, just eliminating E and P would have a whole lot of knock-on effects. So I think what we're talking about is more of a revamp than
right.
a simple.
But it's also, like, the general rule is almost the exclusive rule at this point, right?
Yes.
I mean, we were talking about, okay, if we eliminated E&P, and again, before we get to the losses, what situations would a foreign corporation be paying a distribution up where you need to track it because you don't want to give it a full DRD or tax it completely one way or the other, right? I mean, and I think the only thing we came up with was ECI of a CFC, because for whatever reason, 245 on US source income on CFCs has different DRD percentages from 245 Cap A. And if you wanted to preserve that, maybe you have E&P for US source income at the CFCs.
But the importance that E&P has in the international tax regime currently is so much bigger than just that, right? It's sort of the tail wagging the dog to keep E&P around. Now, one big difference, just to move on in just time, one big difference between Subpart F income and necktie is that Subpart F income is obviously taxed at a higher rate, right? And so I think when we're saying we should make the systems mesh, we're not necessarily saying everything should be taxed at the same rate. I think basketing would still potentially be appropriate, right? We could still have passive income, categories of passive income that are taxed at a different rate from other categories of, say, active income. I don't think that would be at all inconsistent with what we're thinking about in terms of the changes that we would make. We'd, of course, if we do have loss sharing, then losses would have to be basketed as well. And then design choices would need to be made about whether you're very rigid and whether passive losses only offset passive income and active losses only offset active income, and whether there's any kind of cross-crediting. You'd want foreign tax credits to be apportioned to or allocated between the baskets, and there would also be questions about, how rigid are you about the baskets?
But I mean, the basic proposal, right, is if you had 3 categories of income for domestic shareholders of non-US subs, which are domestic, passive foreign, and active foreign, right? And therefore you could tax the domestic and the passive foreign at higher rates than the active foreign. Basically, you're taxing US domestic and Subpart F at a higher rate than necktie. And then you if you could flow everything up on, again, the assumption that this is essentially like a flow-through regime at this point because you are currently taxed from foreign subs, and GILTI and necktie appropriately therefore test at the shareholder level, should we move the subpart F, the passive piece, also up to the shareholder level, right? And have all of the losses track in those three baskets as well, right?
Right.
I
And
think you're talking about getting rid of the EMP concept or CFC. To Philip's point about, well, they just thought of CFCs as like entities, right? And so we use EMP for domestic entities, so yeah, we'll use it for CFCs also. You're talking about two completely different regimes on the domestic and the foreign. Like for domestic, we still care about EMP.
Yeah.
Because for
that-
foreign, we're
that's
taxing it on a
That's an
current basis.
interesting, Mindy, that's an interesting question, and I would say perhaps beyond the scope of this panel, but yeah, so certainly I think we're saying we're questioning the significance of ENP for CFCs.
Yeah, I mean, I think dividends still have consequence in the United States, in the domestic context. I really think it has much less so when you're dealing with foreign subsidiaries because of a full inclusion system. And because everybody is eligible or not for 245 Cap A.
We then need to translate the income coming up into EMP on the domestic for the domestic shareholder.
I mean, I'm not sure I'm following your question, but I think the place where, in theory, you could have to track EMP is a situation where you're not eligible for 245 Cap A,
right.
unless you just decided all cash that comes up is just going to be subject to dividend, like treated like a dividend, which is probably the easier way to go.
All cash that comes up that has not been taxed as full inclusion.
Right, exactly, but
Yeah.
that's zero. I mean,
that's not the vast, the lion's share will have already come up. And
exactly.
the ENP will already have been included in the US
is-
shareholders
it's-
calculation when
exactly.
it's included in income.
And Mindy, just to address I mean, yeah, you can have a corporate partner of a partnership which may itself pay dividends to its shareholders, and you'd have to have some convention at the level of the shareholder to determine how much ENP there is. If you're assuming you retain the concept of ENP at that level, you'd have to have some convention to compute the ENP at the level of the corporate shareholder.
You're saying the
but,
domestic.
But that's still, I think, at least one step further away from sort of preserving a somewhat artificial concept, as we see it, or arguably artificial concept, at the level of the CFC.
I mean, the truth is that a lot of non-US companies that are not CFCs don't track ENP. Right. And you have to know what to do with that when you get it as a US corporate anyway.
Should we talk about loss?
Yeah.
Loss.
I think so.
Sorry, loss sharing across jurisdictions. I mean, I think it's kind of an interesting topic. What do you do about country by country versus blended, right? That's always a question when we're talking about the US tax regime. And of course, the current system is blended, and I don't think there's any appetite to move to country by country, but I think it's an interesting thought experiment. But if we have these three baskets, then I think one, it would make country by country just even more complicated because you'd have three baskets in each country. So we're not proposing that. But what we've observed is that you're actually probably getting a lot of the way to what country by country would try to get you anyways. And so if you've got all your passive income in one basket, and you could just, and as long as you are careful about netting losses and income as between those two baskets, then as we were talking about earlier, you're probably getting along a lot of the way to concerns around allowing losses in Cayman Islands to offset.
I mean, it just reminds me of like all the historic discussion about the 904 baskets when there were like 8 million baskets and everybody said, well, really just need passive and active, right? It's the similar thing, right? As long as you're segregating the active non-US income from the passive non-US income, yeah, you could move your mobile passive income from Cayman to Germany in order to, produce tax credits or losses that you can use to offset Cayman income. But like, why would you? And why do we care? Right? What we really care about is preserving active passive distinctions so that for the mobile pieces of it, that you make sure that you're being taxed at whatever rate is appropriate.
And then we also have to consider domestic income versus offshore income, the two baskets of offshore income. And right now, domestic losses can be used to offset essentially necktie income, but that's an expensive use of losses, right? Because they're losses that could otherwise be used against domestic income tax at 21% that are absorbed by essentially tested income that would otherwise be taxed at 12.6%. And so I think one approach there would be potentially an election, right? Because if you said, okay, you don't have to do that, right? You say taxpayers, don't worry, you don't have to offset those two categories of income. Well, that would actually be unfavorable to some taxpayers because they would have, they could have losses essentially overall they're being taxed on income and more income than they have, right? Because they have losses offshore and income, losses domestically and income offshore. And if they don't have a reasonable expectation to use the losses domestically, they probably actually want to use them offshore. And so one approach would be an election. I don't typically favor elections, but in this particular instance, there is precedent under 965. There was an election there. So that's one potential approach. I mean, there are others.
So you're saying a one-time election?
I don't know about one time, but I just, an election that essentially wouldn't force a taxpayer that otherwise expects to be able to use a domestic
I'm not sure
loss.
why it needs to be one time because it is designed to allow you to game year to year, right? Like it's basically saying you have these losses. If you want to use them against necktie income, be my guest, then they disappear. You don't get to use them in the future.
You can smooth within
or
the year,
you can
or
preserve them
year
in
to
your
year. Right.
And making an annual or whatever election to do that doesn't offend me.
Me neither. As I said, I don't normally like elections, but this one, because it feels like if you say you have to use the losses against your necktie, well, then you're forcing an expensive use of losses to a taxpayer that may otherwise be able to use the losses in the future. And their U.S. business, actually, you haven't allowed them to smooth over accounting periods, which is what our loss carry-forwards are intended to do. But then if you say, no, you can't use them, well, then you've got a taxpayer that may every year have domestic losses and foreign income, and they can't offset the two, and that kind of puts them in an unfair position.
And would you aggregate for that purpose as long as the domestic income and the passive foreign income is at the same rate, would you then allow or just mandate that the losses? Then you have foreign tax credits, right?
Yeah.
So maybe you preserve them in each of the three baskets. You allow, on an elective basis, you to use losses only in the higher tax income baskets against any of them that are at least at that rate. People might choose not to because of foreign tax credits or because GILTI is taxed at a lower rate, but you have that option.
But you wouldn't allow the
and
other
you wouldn't
direction.
allow the other way around because
So at a minimum, you would keep loss carry forwards in the active non-US category in the active non-US category.
That's right, because
those
otherwise
are-
you're using it to offset a higher tax income, which doesn't seem fair.
So I think.
Did we solve it?
We certainly proposed some big changes.
I think the other thing that we talked about is if you're moving all losses up to the shareholder level, you'd also have to move foreign tax credits. Foreign tax credits would all have to be at the shareholder level as well.
Right. And if we're talking about loss netting year to year, it might at first seemed like you could do it within the CFC, but since and that may work if you've got a shareholder that owns 100% of a bunch of CFCs, but as long as you can have, obviously you can, CFCs where their tested income and losses are flowing up to multiple US shareholders, well, in that case, trying to track carry forwards at the level of the CFC becomes virtually impossible, right? The CFC doesn't have visibility into whether each of its US shareholders has used those losses. And so if we do suggest loss carry forwards, it seems to make sense that the income and losses would flow up to the US shareholder, and then any overall loss that they had could carry forward, but the carry forwards would not be at the level of the CFC. And just to note that a lot of these changes would create a very complicated system, but our system is already complicated.
I think this is less complicated than our current system.
I hope so.
It has,
And,
I mean,
and would at least have the seeming virtue, not having enacted it, that you would have consistent rules across the two categories of income, which you can see a clear policy decision for the rate differential, but perhaps less of a clear policy rationale for, as opposed to just sort of what was feasible at the time in having different sort of other design choices for necktie/guilty versus historic subpart F income.
and I think if you are trying to make everything consistent, you'd probably want to get rid of the haircut on the necktie foreign tax credits and allow
Or in
carry
fairness,
forwards.
to at least have a consistent rule about
Right,
the haircut.
consistent with subpart F, but then as a result, maybe you need to raise the necktie rate. I don't know.
Right,
But,
a lot of our changes, they work in different directions. And I think what we're motivated by is logic and consistency. And I think
trying to rationalize the overall architecture.
Right. And then
But some of those are going to have an impact on the FISC, right?
Right. And so I don't think we're saying anything very specific about the rate.
Right,
So
exactly.
the rate is,
I guess all I'm saying is I would rather, from a just pure policy perspective, make decisions about the right rates on each of these categories, but have consistent rules.
Right. So where we are is a little bit of a rough justice, right? We've got some rules that don't make a whole lot of sense in one direction, and other rules that kind of don't make a lot of sense, but where you get to in the end, including the rate, is where we are today. And I think what we're saying is that there's a lot in there that doesn't make a whole lot of sense. If we made the rules more consistent and kind of more logical, then you might need a different rate. We don't know. We haven't studied it. But
So sure, go ahead, Minnie.
No. I mean,
you would have to have some consistency, I think, in the rules for branches. Agreed. Agreed. I was actually about to go in the other direction, though, and say, as you point out, some of these changes would touch on fundamental sort of concepts in not just the CFC regime, but the entire code or the corporate tax regime within the code. So if we wanted to sort of kind of like someone on New Year's Day with the New Year's resolution, if we wanted to start a little smaller and build from there, we also thought about some changes that might be first steps that could be taken that are consistent with the bigger changes that we're talking about, but at the same time might be more achievable, more rapidly achievable, and would be more confined to the CFC regime.
Yeah. So, what we've been discussing thus far, obviously would require laying a lot of new intellectual groundwork and really making fairly significant changes, as was just said, in terms of concepts like E&P and losses and all that. If you want to have something that's kind of ready to go, could be implemented in a fast-moving legislative environment without a whole lot of new intellectual groundwork being laid first. There are a couple of sets of rules that I would describe as basically relics of an old system. One would be the active categories of Subpart F income, the foreign-based company sales and services rules, and the other one being Section 956. So starting with the active categories of Subpart F, why are these a relic now? Well, they're a relic of a time when just as dividends, interest, royalties might be highly mobile and thus considered prone to abuse, and a concern about taxpayers being able to achieve very significant and unwarranted reductions in their effective tax rate through manipulating where they earn these mobile categories of income. Well, in the old days, what taxpayers potentially would be able to do is, instead of earning, sales income from the U.S. That would be taxed at a, federal rate of 35%, come up with some way to shift it to a tax haven, and you could get your ETR down to 0 or just a few percentage points. It's only deferral. It was only deferral, but it could be essentially permanent deferral. And so you're talking about achieving just truly massive ETR reductions through moving this kind of income around. Now, of course, with GILTI, or now NICTI, and with FDII, or now FDII, the rate reductions that are achievable through that sort of mobile income planning are far narrower. Right now, if we're talking about selling goods or services into a non-US market, your kind of minimum rate under GILTI or NICTI is approaching 14%. And by the way, that's about what it would be under FDII if you had just made those sales as qualifying FDII sales out of the US. So this is all narrowed. If you look at what was done in OB3, there were kind of like, from a taxpayer perspective, both positive and adverse changes, but by and large, both kind of sweetened, especially the expense allocation changes, and then the sort of cleaning up of QBI anyway. And so I think there's not a whole lot of, and when you think about the complexity and the potential traps for the unwary as companies revisit their supply chains, seems like we're incurring a lot of administrative expense, a lot of deadweight loss to police extremely small ETR reductions. And by the way, what we're leaving is the possibility for affirmative use of taxpayers deciding to plan into Subpart F because it might benefit them from a foreign tax credit perspective due to the differing foreign tax credit rules. About 5 years ago, during the Biden administration, when they were working on the Build Back Better Act, a similar proposal to substantially eliminate these rules was scored as a sort of moderate revenue raiser, about $12 billion over the revenue window at that time. If you didn't like the idea of repealing the rules altogether, there are other ways that you might come at this. You could establish a separate basket for these rules, so to sort of contain the sort of foreign tax credit cross-crediting that might be possible by planning into Subpart F. You could, if you believe what I'm saying about how the delta has been narrowed between FDII and NICTI in terms of ETR, you could say, well, that is the case mainly where you're talking about serving non-US customers. When you're talking about serving US customers, if you do that from the US, you're still subject to kind of full corporate rates. And so you might just, if you wanted to be more conservative, arguably from a revenue perspective, you could imagine just eliminating these rules for foreign-to-foreign transactions. So that's something that could be considered. And then I guess the last point I would make on the active subpart F is these rules have come up quite a lot of late in connection with tariff planning. And so obviously with all of the recent US tariffs and then retaliatory measures from trade partners, it's created an environment where companies are constantly reevaluating their supply chains. They're really trying to have playbooks ready for, what if this country does this and that country does that. It really is a little scary in some respects that major supply chain changes might be made with a view to kind of managing trade policy exposure, and you could if you're not paying close enough attention, you could create a fairly significant income tax problem. Briefly on Section 956, another relic. It's a relic in that, as we've discussed, our old system was a worldwide system with deferral, and the whole mental model of taxation of U.S. shareholders under that system was one of a distribution. The distribution is the thing that our system is going to tax. As we've discussed, that's no longer the case, and yet we still have these complex Section 956 rules that try to police effective repatriation. So the thing that the system wanted to tax was the act of repatriation, but taxpayers come up with some devious way to do something pretty similar without an actual distribution. And so shouldn't we police that? Made a certain level of sense under the old rules, would seem to make very little sense under the current rules, particularly for corporate taxpayers, which get the full GILTI deduction and all that. So this is another area where there's administrative complexity and traps. This comes up perhaps most notably in M&A planning and being able to pledge CFC stock. It would be nice to, the markets would certainly like to be able to use, it would be nice for borrowers to be able to pledge all of their CFC stock, but that's still potentially fraught with peril as long as we have Section 956. And so that also seems like one that we might be able to lose.
Before OBBB, people were making the case that we still needed 956 for individuals, right? Because of QBI, basically, right? And now we've gotten rid of QBI.
Yep.
So I guess I'm asking, again, what is 245 Cap A doing? Why do we need to even limit this to corporations? Everybody's including everything at this point.
And maybe even in the vein of taking on even smaller issues. At least insofar as Section 956 applies to corporates, most corporates do benefit from the deduction, right? So the 250 deduction applies to 956 for corporates. And so, in my experience, at least as a practical matter, what that ends up being is just a diligence exercise and an expensive and time-consuming one, and one that is fraught because there are traps for the unwary. There are traps that are intended to be there, and then traps that are, I don't know if they were intended, but they're less able to be understood, at least by me. For example, the nimble dividends, the difference between the E&P that can be calculated, it can be picked up by 956 inclusions and maybe not picked up by section, the deduction. And so, from the market's perspective, what I see is that absent specific circumstances, and really two specific circumstances, I don't see pledges of foreign assets or guarantees from foreign subsidiaries any more than I used to, because doing so, in order to be able to do so, you have to run the traps on the Section 250 deduction. You have to think hard about, do I really get this deduction because I'm really going to have this income inclusion? And the two specific circumstances are in distress scenarios and scenarios where you might have a U.S. borrower that has all or most of its assets offshore. Then in order to be able to give a real pledge, that that domestic borrower would need to pledge foreign assets. And I think there it's probably worth running the traps on the deduction. And likewise, for in a distress scenario where you're sort of pulling together all the collateral you can get, then it's probably worth running the traps. And so, but for all of the other cases, I think the theory behind 250 is that the borrowers should be able to pledge those assets, that it doesn't present an abuse. But as a practical matter, they don't, because of the diligence exercise. And so, if we're suggesting small changes, I think the smallest version of this change is just get rid of 956 for corporates.
Although just to put in a plug for getting rid of it for non-corporates also.
I'm not saying not.
It sort of seems like is the juice worth the squeeze there, even for non-corporates? I mean, it's really just a question now that you have a minimum level of tax. I mean, and currently, actually, you could ask why, without any type of rate preference for individuals, on necktie, like why you should retain 956.
And no Cuba,
no Cuba.
right?
I think
so
that's
what are you worried
yeah,
about?
there's really all the income is going to be taxed anyway.
Yeah.
It's
Exactly.
Like, it's a deemed dividend. It doesn't really have any benefit.
Okay, I think we're going to shift to.
So I think having solved the problems under domestic law, I think we're going to.
Round tripping, like, so you eliminate active, subpart F active, but keep it for like kinds of sales that you do.
I'm saying the most conservative version of this idea would be, yes, I'm certainly not proposing a round tripping rule, like automatically treating round tripping as full rate subpart F income. That is not, I think that would be rather harmful. But given that everybody is, albeit at the cost of some complexity, coping with the current subpart F rules as applied to, all CFC transactions, regardless of where the customer is, if we were able to provide this simplification only for foreign-to-foreign transactions, that wouldn't be the word. That would still be a day well spent.
It's not really. I'm very intrigued by the idea of the three baskets. So I'm just thinking about it. I want to make sure I have it right. That's really my question. Is taking the existing categories of subpart F income, effectively just kind of consolidating them into 951 Cap A. And I'm not going to get into the debate over whether it's necktie or NICT because I'll make half the room either way. And then changing 250 to make like foreign personal holding company income ineligible for the deduction, and then having just one set of foreign tax credit rules, one high tax exception that applies to everything. Is that, am I describing basically
I think so.
Yes.
Okay.
Yeah.
I guess I think it's very intriguing. I think the one thing I would want to make absolutely sure of, and I would want JCT's like sign off on this, is there isn't some grotesque tax planning on foreign personal holding income that we haven't identified that could arise under that change that doesn't arise under the current subpart F treatment, right? Like, I can't think of anything off the top of my head, but I would just kind of want people to do some real thinking on that and make sure it didn't open up something big.
It's a good point. We don't have one in the back of our minds that's motivating this proposal.
It's not a setup.
You can do that because we're only allowing losses in the baskets go from high tax to low tax, not the other way around.
Passive losses, yeah.
That's how we would police that.
Okay, so having solved all the problems under domestic law, we figured
we should talk about
we got
Pillar
about
2.
something like 10 minutes, so we figured we'd just polish off Pillar 2 also.
Yeah.
You only need 8 minutes for that.
while we're at it. And specifically, I think we wanted to talk about the interaction of all this with side-by-side safe harbor, and whether, first of all, any of the changes that we made here would, in theory at least, impact the United States qualification for the side-by-side harbor. And then, as an alternative, should we just be scrapping this altogether and moving to a Pillar 2 system? And I think, as a preview, we think on the first question, probably not, depending how far you go down that, and depending on rates, you could be in a situation where the rest of the world starts to exclaim. And then the preview on the second piece is, on Pillar 2 is, no, we are actually closer to a Pillar 2 system. I think making these changes would make us closer still to a Pillar 2 system. But there's not a real good reason why we should have to conform to Pillar 2 otherwise, particularly in light of side-by-side and the policy behind that, to the extent there is. I think there is a policy behind it, and that, you know, we should not have to scrap our whole system for Pillar 2. So just as a quick note of background on the side-by-side safe harbor, this was guidance that the inclusive framework provided in January of this year that creates a safe harbor for jurisdictions where the determination was that even though they're not otherwise compliant with Pillar 2 and the inclusive framework, their tax systems share the similar policy objectives, scope, policy impact as Pillar 2. So the idea is, like, why punish them just because you have your own system, as long as that system goes to the same basic policy objectives of Pillar 2. I think we need to distinguish between how the side-by-side safe harbor came about and what it is designed to do, because how it came about was that the United States basically strong-arms the inclusive framework into doing something by threatening Section 899 of the code, which would have been retaliatory withholding, and the US convinced the G7 that in exchange for giving up on Section 899, they would build this side-by-side framework. Putting that aside, the general idea makes sense, I think, on the side-by-side framework, which is US has its own system. We're never really going to move to Pillar 2 completely. And so looking at what the US system is meant to do, it does fulfill most of the policy objectives, and generally we are subject as US multinationals to a 15% global overall effective tax rate. So there are 4 conditions to qualify. One is that you have an eligible domestic tax regime, which is a minimal effective overall tax rate of 15% on domestic income, an eligible worldwide tax regime, which is a minimum effective overall tax rate of 15% on foreign income, a foreign tax credit for qualified domestic minimum top-up taxes. It's the same basis as other eligible taxes, and the system has to be enacted before January 1st, 2026. And then if you do apply for the side-by-side safe harbor, what it does is it eliminates the income inclusion rule and the undertax profits rules, which are the 2 Pillar 2 top-up taxes that permit other entities up the chain or in the general group to impose a tax if the jurisdiction of the entity at which the local tax is being imposed does not impose a QDMTT. So it doesn't get rid of QDMTTs, but it gets rid of somebody else coming in and saying there was no tax at the local entity's home jurisdiction, so we're going to impose a 15% top-up tax. So far, the United States is the only one who qualifies, although Brazil is applied. And the idea is that it should be an overall impact. So you look at the overall likelihood that US multinationals will pay a 15% tax. There is an ongoing obligation on the part of the United States to notify the inclusive framework of any material amendment that could affect side-by-side safe harbor. And there is a stock take that is generally happening with respect to Pillar 2, but one of the things that's supposed to happen in this stock take is think about whether the side-by-side safe harbor is working, and that's going to be concluded by 2029. So the first question, as I said, is do the changes that we talked about, let's say the big picture change of conforming Subpart F and necktie to a single system of passive and active income, is that going to risk US eligibility on side-by-side safe harbor? And if you look at each of the changes individually, I would say no. We still have the same minimum taxes. We still have taxes on domestic and worldwide income. We still have foreign tax credits for QDMTTs. We're not adding a new benefit like the R&D credit that would undercut that tax. But a couple of the things sort of all taken together could, in theory, be a problem. And what we were really thinking about is if we start having carry forwards for necktie, which we don't currently, and we get rid of a lot of categories of Subpart F to just cover passive categories. And let's say we got rid of the 90% haircut on foreign tax credits, you're reducing our potential minimum tax that we're doing to something more approaching necktie, which is 12.6%, and significantly lower than the not significantly lower than the 15% tax under Pillar 2. US multinationals are generally paying more than that, but it's not clear to us how much of that is Subpart F, how much of that is just being in high tax jurisdictions, which isn't really about the US taxing system, but more about where US multinationals tend to do business. So in theory, maybe there's some pressure to up the necktie rate if this happens, but otherwise it still seems compatible with the general notion of a minimum tax on foreign income.
And that's sort of a similar point that we made before, which is we kind of have to take stock of all these changes in the aggregate and think about the effect on the fisc. And I think it's the same point that if we were worried about that, we'd also be worried about side by side, and vice versa.
Exactly. And then the second question of should we just switch to a fully Pillar 2 compliance system? I know I'm running out of time, but very quickly, it would require a lot of changes for conformity. I mean, is kind of the short answer. Not only the changes that we talked about being big CFC reform, but other things such as starting with financial statement income instead of taxable income, which I think is a big one, even if you change everything else on carry forwards. Having to change to a country-by-country system, which is a big change for us, for necktie. It would maybe make things a little easier for some subset of US multinationals that are already figuring out Pillar 2, but it would make things more complex because we have a whole bunch of other taxpayers that aren't subject to Pillar 2, including people who are not big enough US multinationals, and individuals and so forth.
Would you have parallel systems?
Yeah, I mean, you kind of want to change everything if you're going to change it. And so that's a very big change. As big as our earlier change would be, this would be a much bigger change. And it feels like it really doesn't seem necessary as we've gotten closer with this notion of a 15% kind of ish minimum tax. And I think with the side-by-side safe harbor, we don't really have a good incentive to do that. Like we're covered. And so having our own system, making our own rules is probably better off for US multinationals on the whole. I think there's still a little bit of daylight for people who are not US multinationals but have CFCs under US subs. So if you're a foreign multinational and you then have a US you bought a US company that had CFCs, I think Pillar 2 still can be an issue, despite the side-by-side. But in the scheme of things, not a good reason to move to Pillar 2. Anybody have any?
In a way,
I agree.
In a way, the two questions may dovetail with each other. Would we continue to comply with side-by-side, and should we move closer in our domestic law to adopting either Pillar 2 or elements of Pillar 2? I mean, and to the extent that on the first question, I think the fundamental policy is the U.S. has its own very comprehensive rules that are designed to achieve the same policy goals as Pillar 2 is. They have evolved over 100 years in a particular way, which is different than the technical, several of the particular technical requirements of Pillar 2, but fundamentally they're sort of meant to achieve some of the same basic goals. And to the extent that you're moving some of the furniture around after January 1, 2026, but in a way that doesn't change the ultimate intent and effect of the system, should that does the same rationale for applying the side-by-side exception continue to be compelling? Just as a footnote to that, some thought could be given to what kind of data, if any, could be sort of shared with the inclusive framework to try and assure them. Maybe this, in a way, loops back to George's point of a few minutes ago that there isn't somehow some nefarious hole that's going to sort of just suck a whole bunch of tax dollars, into nowhere. But assuming that there, that I think perhaps that there is some type of data that might support that. That seems like a fair conclusion, which in turn raises the question, as you've described, is there really a reason, given that we have a single set of CFC rules currently that applies to all taxpayers, and we would need to, if we tried to explicitly move closer to Pillar 2, sort of figure out, are we overhauling the rules for all taxpayers? Are we overhauling rules for a very important subset of U.S. taxpayers? It sort of takes some of the pressure or incentive off of having to come to grips with that.
Yeah, I mean, in all of this, I think our changes are largely intended to more effectively and efficiently accomplish the stated goals of the system. I don't think we're suggesting big policy changes, right? These are changes in how to implement the system. And so as long as the policy remains constant and we watch the actual impact, the numbers, whatever data that Philip referred to, that really shouldn't impact side by side.
I think the real side-by-side constraint is on the CAMT. If we're talking about CAMT, then I think it's a much sadder story.
It is, and CAMT is a sadder
Yeah.
arrangement, and so the question of like, can we get rid of CAMT and still be in side by side is a generally sadder.
Beyond the
Yeah,
scope of this
exactly.
panel, yeah.
Philip, to your point about, there's not some hole where all the taxable earnings would get sucked into. Isn't like that $1 trillion of expected spend on data centers and AI infrastructure, isn't that such a hole that's like $1 trillion of losses that if CFC earnings are offset by those losses, that kind of would eliminate, I'm not saying it unjustifiably, but
But otherwise, it's going to eliminate U.S. income, right?
I'm not, I guess my point is not like what's right or what's economic, but what the perception is to your point about, we make the case to other countries that our system is doing what it's supposed to, and then the result is.
We have a lot of expenses.
maybe I would just say, I know we have another question in a second, but I would just say that you could also ask, perhaps under current law, sort of what the result might be. But
so two maybe related or interconnected questions. First is the proposal to get rid of the passive foreign personal holding company income groupings that currently exist as part of this basketing of passive income, or would the idea be to keep those and the high tax kick out intact? And then the follow-on is, it seems like through the legislative history, losses in Subpart F have been disfavored, and I think that's because the idea was this should all be in the U.S., and if you're moving it offshore, it's probably for nefarious reasons. And so if you have losses there, we generally have made it very difficult to use those. I mean, the EMP limit sometimes, if you do good planning, lets you use them, but like oftentimes they're not. So I guess my question is wouldn't sort of a policy parity to what we have now here be to either disallow those losses and let you get it when you liquidate your stock if you really have economic losses, or two, if you want to be a little more simplistic about it, maybe drop it down into NECT and maybe draw an analogy there to how we phrase some of the Subpart F rules, which is like gain and excessive losses is Subpart F, right? Where you sort of leave ambiguous whether losses are necessarily Subpart F, and that would sort of suggest that maybe those losses should just kick down into your general non-Subpart F income if that's where you land.
I mean, maybe to take the first one, I don't think we're proposing to get rid of the passive categories of Subpart F income. I think those passive income presents a different set of policy concerns. That's income that if you earn directly from the US would be subject to the full rate. And so this sort of narrowing of the ETR delta is a lot less applicable for truly passive Subpart F. So I think we probably keep those around.
Mm-hmm.
On the losses.
So sorry, I just want to clarify the question. Are you suggesting that losses that would otherwise fit into the Subpart F category should maybe not be allowed against Subpart F income, and instead be used against the passive income, and instead be used against active income? Was that your question?
Or loss completely?
Right now, they have to be in the same passive foreign personal holding company income grouping in the same year, in the same CFC, which basically means unless you planned into those losses, you don't get to use those losses. They just evaporate outside of special industries.
Yeah, I mean, I guess you could, if you thought that was reasonable, you could just not have loss carry forwards in the passive basket and not allow it to be used against income in other baskets. I'm not sure that policy is really sensible, but
Yeah, I mean, there's not a lot of losses in that category, right? And there's capital losses that could offset capital gains, but a lot of categories of Subpart F income are like interest and dividends and things that the gross amount and the net amount are the same.
I can see that more. Are you focusing on using losses against passive losses against passive income, or using passive losses against active non-U.S. income?
Just sort of highlighting that any of the changes for losses
Yeah.
proposed seem more favorable than status quo, and sort of asking whether the commentary there is that the current rules are inappropriate and should be changed, or is the commentary like, because it seems like parity would be something a little harsher, maybe treating it as like a test of loss for NIFTY or something at a lower rate, but not necessarily letting it offset, say, a different CFC's passive income.
Mm-hmm.
Curious if that's how you see it or not, I guess is my question. Do you see it as more favorable than the existing regime?
Yeah, I mean, I guess it is a little bit more favorable, right? But right now, to your point about like you can plan into it, I mean, people do plan into it, right? So I think that changes that allow you to get the same result as you would otherwise get if you just planned aren't necessarily bad. I think that the changes to the use of loss that I've sort of been focusing on are like carry forwards and carry backs and blending across types of income, like active income. I hear you, and I think that's something I'd kind of want data on to kind of understand how impactful it is.
Yeah, I have the same reaction of like, I just don't know how much, other than capital losses,
yeah.
What are we talking about?
Right.
Presumably how we treat those losses could swamp any revenue from eliminating EMP limit, right? So you could end up.
Exactly.
How do you write those rules?
Yeah, exactly. Yeah.
Yeah, that's fair. That's fair. All right. Well, Yeah, I
Any
think
questions?
we're all good.
Great.
Much
All right.
appreciated.
Thanks, everyone. So that concludes today. So tomorrow our registration starts back up at 8:15, also breakfast, and the first session is at 8:45 a.m.